We've had some reports on inflation and inflation expectations, which weren't great. If that continues, that could cause the consumer to pull back.
With inflation sticky, growth strong, we just didn't see scope for the Fed to be cutting rates this year.
Inflation will be sticky. We'll basically be living with a high inflation target.
In our view, slowly but surely, it is heading close to 2%.
What we're seeing right now is the biggest catch-up in history between soft data and hard data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday on a pretty mild two-day winning streak. Your scores look like this on the S&P 500. Equity futures positive by just 0.2%. Likewise on the NASDAQ. Check out the bond market. On a run of 8 consecutive days of rising 10-year bond yields, the longest such streak going back to 2022. This morning on a 10-year, look out below, we're down 2 basis points. The mercy of the price action today is all on this. The earnings a little bit later. We'll hear from JPMorgan, Citi, Goldman, Wells Fargo, and on the data side, Anne-Marie, U.S. CPI.
CPI is really going to be the star of the show this morning. I go back to what John Author said 2 days ago. We were at this point really supposed to forget about CPI. It was trending down. The Fed was cutting rates. But now everyone is starting to worry about expectations of what Trump 2.0 might mean for the inflation picture. We know we talk about University of Michigan. It's colored with the, politics, but they are finding that expectation for inflation in 5 years are now higher than they ever were during the spike in prices of 2022. And that expectation is that self-fulfilling prophecy of potentially higher prices.
The most important data point this month, not payrolls, not CPI. Inauguration on January 20th. I think this market is bracing for that and a stream of executive orders.
That's why I think the market reaction to today will be so interesting. Will it be a redux of PPI where we basically get the number in and we say all this is a jumping off point for inflation to come, that we're more worried about the future. So even if you get a number that's in line, you could still have a treasury market that refuses to rally because we care about what happens next week. Everyone says we need uncertainty to clear up, but who's to say uncertainty won't be sticking around even after next week?
Well, it's the politics that are driving this economy. The political economy for 2025 is going to be so important. And we've seen that play out over the course of the past week. This market just whipsawed by different trade tariff stories coming out. Is it going to be gradual? Is it going to be narrow? Is it going to be blanket? And that already is fueling this uncertainty. And when it's uncertain, you have to start pricing that in.
We've had 3 over the last week. The Washington Post, CNN, us here at Bloomberg in the last 24, 48 hours or so. Only one voice matters, and you'll hear from that man a lot, the incoming president of the United States, Donald Trump. Got lots of earnings this morning. This comes from BlackRock. Fourth quarter EPS, $11.93. The estimate, $11.46. On assets under management, some huge numbers. A little bit lower than expected, $11.55 trillion. Still massive. The estimate, $11.66. More on the numbers a little bit later. Equity futures right now in the S&P positive by 0.2%. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley ahead of fresh inflation data. James Lucier of Capital Alpha Partners as Trump floats creating an agency to collect tariffs. And Gerard Cassidy of RBC as big bank earnings kick off on Wall Street. We begin this hour with stocks steady ahead of CPI at 8:30 Eastern Time. Investors looking for clues on the Fed's rate path. Andrew Sheets of Morgan Stanley writing, we think CPI will show a downtick in core inflation and support the case for a March Fed rate cut. An elevated reading would put that view in jeopardy. Andrew joins us now for more. Andrew, welcome to the programme, sir. Lots to get through this morning. Bank earnings and data as well. Had a big backup in Treasury yields over the past month or so. Do you think we're in the so-called buy zone right now?
Yeah, so I think we're pretty close to it. I mean, if certainly if we take a longer term view, our forecasts at Morgan Stanley are very much for global bond yields, including Treasury yields, to decline. We have more Fed rate cuts in our forecasts than the market. We have them happening sooner. And we do think that inflation readings in the first half of this year will generally be declining. And there are a variety of reasons for that, but part of it is our read on incoming Trump administration policy, that we think that policy might be announced quickly, but the implementation will be slower, and so it will slow up. It will show up somewhat slower in the data. So I think if you get all those factors, and again, today's CPI reading is pretty key, that should lead to pretty good total returns for bonds on our forecast over the next 6 to 12 months and creates a pretty attractive case. Now, today's CPI reading is important for that view. And obviously, we need to see, we're going to get a lot more information, as you were talking about at the onset to this program, about the administration in the next week. So we need to keep an open mind. But on our current thinking and our current numbers, we think bonds look pretty attractive here.
Andrew, can we just sit on the why you think we have backed up in the fashion that we have over the last few months? I was reading through your research and you offer two choices: pricing in stronger for longer, or are we discounting a greater fiscal premium? Which one do you reckon it is?
Yeah, so I would be in the camp, and a lot of my colleagues are in this camp, that we're pricing in a stronger U.S. economy for longer. You know, you've had a steepening of the Treasury curve, you've had higher real rates, and you've had some pretty good data. You know, you had a strong U.S. jobs number. You know, President Biden is going to exit as the first president to never have a negative NFP number on his watch. And Atlanta Fed, you know, real-time GDP for the fourth quarter is exiting the fourth quarter pretty strong. So I think you've had strong data, you've had yields going up on the back of strong data, the curve steepening, higher real rates. I think that's all a pretty internally consistent story of the economy is somewhat stronger than the market was expecting. The other caveat we have to remember here is think back to last January. You know, January can be a time when the market overreacts a little bit. And last January, the market priced in, with hindsight, way too many Fed cuts, way too early. And if I think about where the market's pricing versus our current economic forecast, we think the market's now pricing too little from the Fed relative to what we think they'll ultimately deliver.
Andrew, why don't you buy the idea then that there's some sort of uncertainty premium that's being built into yields? The uncertainty of fiscal policy, the uncertainty of what we might get on tariffs and deportations, and that's commanding richer premiums. Is that not part of the story?
Well, that's a fair point. I mean, I'm sure that's some of what's going on, and that might explain some of the move. We don't think it explains it all. But I guess where we kind of have some difficulty with that explanation, or that explanation, you know, explaining the bulk of the move, is first, we don't actually expect very large fiscal shifts very quickly in the U.S. We just don't think the Republican majority in the House is large enough to accomplish those things, or at least accomplish them quickly. And I also think that those risks are somewhat two-sided for Treasury yields. Yes, if you see, you know, more aggressive tariff or immigration policy sooner, that could drive up inflation. And indeed, we would expect it to drive up inflation. But it could also weaken growth. And in an environment where growth is weakening because you have more disruption in the labor market, because you have more disruption through trade, well, you know, that could argue for yields being lower as growth is disrupted. So we think that those risks are maybe a little bit more two-sided from the policy uncertainty than the market is currently reading.
Even so, that move higher in yields did have the ability to spook equity markets. But Andrew, the weird thing about it is that credit wasn't shaken at all. On Monday, when you had 10-year yields move higher, something that maybe should have disrupted it, you still had $15 billion worth of issuances. Yesterday was much of the same. Why is this credit market not reacting?
Yeah, that's exactly how we're seeing it. You have a very solid, a very strong credit market. And I think there are a couple of reasons behind that. I think first is, you know, this is a credit market that I think a lot of investors would describe as a good yield and kind of a bad spread. You know, yields are quite high, nominal, real, relative to history on the corporate indices. Spreads are low. And I think a lot of the buyers of credit at the moment are more yield driven. They're buying it because they like that yield. They like 5.5% on U.S. investment grade credit. And they're not as sensitive. They're not buying it for the spread. And so I think that allows the market to be a little bit more independent from what's going on. And, you know, I also think that you have still a backdrop where corporate aggressiveness is picking up, but it's nothing too extreme. You know, I think we haven't yet. We have seen M&A picking up, but we're not hitting the levels of corporate aggression, of releveraging that we think are really yet going to worry credit investors. And I think those are both quite important factors. And then you can maybe layer on a third. You know, we talked initially about, look, there are two ways to read what's going on in the bond market. Maybe it's concerns around fiscal uncertainty. Maybe it's a stronger economy. Well, if it is a stronger economy and a stronger for longer economic expansion, that I think would be very consistent with the credit market liking that and being somewhat more relaxed.
Andrew, if we could just go back to the fiscal uncertainty, I hear you that the Republicans have such a slim majority, historically the slimmest they've ever had in the House of Representatives. But if they don't move on tax policy, TCJA does not get extended. They have no choice but to move. So what are you baking in that gets done out of Washington this year in 2025?
So we are thinking, we do think there will be an extension done, but ultimately, we see that as more of the status quo, i.e. you currently have those taxes, those lower taxes, those tax cuts in place. They get extended. So yes, it is, the deficit stays wider, but it's not necessarily a large change versus current policy. And again, that's one of the reasons why we don't think it might have such a large impact on yields or uncertainty premium. And then again, I think we ultimately think that the scope beyond that extension is maybe somewhat more limited because you have, as you correctly mentioned, such a historically small majority. And I think even within the GOP caucus, there's not necessarily agreement on the level of fiscal expansion. So we have to keep an open mind. We have to. I think we're going to learn a lot, I think, over the next month about where that majority actually sits and what is possible. But in our baseline, we don't have such a large fiscal change. And that's one of several reasons why ultimately at Morgan Stanley, we're forecasting yields lower on the horizon rather than higher.
Once they figure out the sequencing, then they'll start to talk about actually what it looks like in terms of top line figures. I've heard anything from under $2 trillion to maybe as high as $6 trillion. Do you have a forecast, or do you think there is a level that at some point this bond market can't handle?
So, look, I think this is a question that is again, I think over the next several months, we're going to get a lot more information and we're going to have to be adaptable to it because, as you correctly mentioned, throughout the election, there were very wide range of forecasts around GOP budget proposals. And a lot of, I think, kind of disagreement around what sort of cuts are possible to offset potential tax cuts, and also what sort of revenue raising scenarios are realistic. So I do think first, and I think this is the most important factor, it's less about the number, but it's more, I think, about how the market sees the realism of either those cuts, spending cuts actually being enacted or taxes actually being raised. And spending cuts are difficult. Most of the U.S. budget is to the military and to entitlement programs, both of which are very popular among the voting public. And so, again, that's a reason why we're a little bit more skeptical that cuts can get done. And thus we're a little bit more skeptical that you can get large additional tax cuts because there's not the offsetting spending cuts there to do it.
Andrew, just wanted to finish on the financial sector with you. Speed kills. The Fed moved fast and broke things back in 22, 23 in the banking sector. But persistently high rates as well can cause pain too. And I just wonder, Andrew, from your perspective, whether corporate balance sheets have the capacity to weather the storm. Because there was a conversation for a long, long time about surviving until 2025. Well, 25's arrived and people are talking about no rates at all. So I'm just wondering from your perspective whether we can handle that.
Yeah, Jonathan, I think we can. And part of that's because corporates have termed out their debt significantly. Part of it is on our analysis, corporate interest coverage, their ability to pay for that debt's been now pretty stable for several quarters. So corporates have had time to adjust for this level of yields. I also think if we go back through history, it's often been modest Fed cutting cycles that have been the best for credit. That soft landing that a modest rate cutting cycle represents is much better to more cuts, but a lot weaker growth. Now, we don't think that applies to everything. Our year ahead outlook at the end of last year, our U.S. credit strategists, they turned cautious again on U.S. CCC credit. That rallied a lot to end the year. I think it's some of the weaker parts of the market that are more vulnerable to higher for longer. And I think a trend, a theme at Morgan Stanley generally, even to my colleague Mike Wilson on the equity side, is quality is a pretty important factor here, and up in quality can still make sense if the premiums to do so are reasonable.
Andrew, appreciate your time, sir. Always good to see you. Andrew Sheets there from Morgan Stanley on a big morning here stateside, 8:30 Eastern Time, US CPI. Before we get there, earnings from JPMorgan, Citi, Goldman, Wells Fargo, all coming up throughout this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. Southern California faced another night of extremely critical fire conditions due to high winds and minimal humidity, leaving 10 million people at risk. The fires have already claimed the lives of at least 24 people and have burned down more than 12,000 buildings. The Biden administration is planning to unveil more rules aimed at limiting exports of advanced chips to China. Bloomberg has learned the White House intends to announce the measures in the last few days of the Biden administration. The new rules will target chip producers like TSMC, Samsung, and Intel. And Volkswagen is bracing for another difficult year. Sales for the German car maker are expected to decline in 2025 due to a lack of new electric car models amid delays in software development. Plus, the company has struggled to compete in China, where local manufacturers are dominating the market with affordable electric and hybrid models. Volkswagen CEO is working to restructure the company, but new models won't be available until later this decade. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, bracing for tariffs.
In terms of the economic policy writ large, there are more questions than answers at this point. While transaction man is going to be there, tariff man will also be very much present. We are preparing for increased tariffs.
That conversation up next. Live from New York City this morning. Good morning. Got a big couple of hours coming up. It starts this hour, but looking for numbers from JPMorgan in the next 40 minutes or so. Before we get there, equity futures right now positive by 0.2%. And check this out. 8 days without falling yields on a 10-year yield. This morning, they're falling. We're down by 2 basis points. Let's see if this holds. The 10-year, 4.7698. Under surveillance this morning, bracing for tariffs.
In terms of the economic policy writ large, there are more questions than answers at this point. Don't underestimate President Trump in terms of how deep-seated this ideology is. He's been talking about tariffs since the 1980s. While transaction man is going to be there, tariff man will also be very much present. We are preparing for increased tariffs.
So here's the latest this morning. World leaders in business preparing for President-elect Donald Trump's expected tariffs. Trump proposing an external revenue service to collect tariffs on foreign imports, writing on Truth Social that foreign sources will finally pay their fair share. James Lucier of Capital Alpha Partners joins us now for more. Now, James, I'll kick this off with a dangerous question. Can you make sense of that? Does it make sense?
It's typical Trump riffing. He is trying to upset people and set things up for whatever transactional bargaining strategy he has. The fact is we already have an external revenue agency. It's called Customs and Border Protection. So think about the Jerusalem Embassy, formerly the Jerusalem Consulate, with a new sign on the door. Think about the Space Force, which is another office in the Pentagon, again, initially with a new sign on the door. So he can call it what he likes, but the reality is there's nothing really changing here.
So this is a branding exercise. Is that what you're saying, James?
I think it's a branding exercise. It's also something of a mind game. Personally, with regard to taxes, I can tell you there is no $10 billion tax cut coming, not even a $6 trillion tax cut coming. It might be two, and it might not come until December or October. So market expectations are out of whack there. Similarly, there's going to be no across-the-board tariff. I do expect some tariffs from Trump. I expect probably a scary tariff memo when he does his day one executive orders, but we're probably going to see much more selective activity, sector-specific tariffs, I think, from Trump.
Well, James, I think we can learn a lot from what Trump says and what he doesn't say. He did not come out like he did with the Washington Post article about tariffs and say that is fake news when it comes to the reporting from my colleagues, Jenny Leonard and Saleha Mohsen in Washington, D.C., about a gradual approach to tariffs. But then he did come out and say External Revenue Service will be this new department that collects our tariffs and duties. So there's still a lot of emphasis on tariffs at the moment from Trump. But what you think that you can read between the lines is that this is going to be more narrow and targeted and smaller incremental increases?
I think there is more bark than bite here. And I think that just as the narrow, rickety House majority limits what can be done on taxes, frankly, that also limits what Trump can sustain politically on across-the-board tariffs, too.
Can I ask about this tension, James, this idea that it's more bark than bite? The idea, as you say, we'll get a scary tariff memo, because there needs to be a seriousness from Trump for Europe, for China, to pay attention to what he's saying. But implicit in that is that investors trading in this market are kind of like, well, we're smart enough to see through that. We can see through the bark, but for some reason, the European officials and policymakers won't be able to. Is there not somewhere where rubber needs to meet the road, that in order to be serious to his partners, it also needs to be serious to the markets?
Well, I'm just back from a week in Tokyo. I can tell you that the Japanese attitude towards Trump's tariffs is much more pragmatic, and it's much more similar to the attitude we see in New York, where it's wait and see. How much of this is bluster, we really don't know. It is remarkable, or at least on my last trip to London, it was remarkable to the extent to which UK and European investors I talked to were taking every word literally and preparing for a massive US-European trade war. You need to realize that Trump has a particular target in mind. It's China. It's not the European Union. It's not the UK. And you should bear in mind that they are ultimately going to be the center of the strategy, whatever that strategy emerges to be.
What is his goal in Europe then? Because we've heard Trump talk a lot about it, to the extent of speaking with Bloomberg saying he's potentially more worried about his allies than others.
Well, that's true. If you go back to Trump's early career, as you mentioned on this program, I mean, Trump once took out a full-page advertisement in the New York Times excoriating Mercedes-Benz for importing cars into the U.S. at very low tariffs. That's a long-time theme with his. I think that in Washington there is just an intense feeling of irritation, even outrage with European regulatory programs, whether it is AI, whether it is privacy, whether it's international taxation, whether it's a whole host of other areas where the European view that the EU can be a regulatory superpower is going to start facing some serious blowback in Washington. And I would see the use of tariffs as a way to start deferring or deterring things like that overreaching regulation or digital service taxes or, similar proposals.
James, there's one deadline they need to deal with, or it can have serious market consequences, and that's the debt limit. And based off a few days of reporting in Palm Beach, the sense I got was that Trump wants this out of reconciliation. Will they have the Republican votes, or are they going to have to rely on Democrats to get this through?
I don't think they have a plan. Obviously, in Washington this week, the Republican leadership are briefing their members in conference meetings, trying to come up with a plan. But they have members like Chip Roy and Tom Massey who have never voted for a debt increase. I think it's something of a desperate effort to say that we're going to tie the debt limit increase to the aid for fires in California. The reality is that they don't know what they're going to do here. But I will make one prediction, and I think that we are seeing the last days of the debt limit. This is a completely anachronistic, irrational policy that dates from 1917. I'm not going to predict that the debt limit is eliminated or abolished this year. But I don't think we're going to be seeing it very much longer just because it is an intractable problem. And just as Nixon went to China, you're going to see a Republican president come out, as Donald Trump already has, saying that we should simply abolish the debt limit or, frankly, restructure the debt limit the way David Malpass proposed in the pages of the Wall Street Journal last month, making sure that there is no default, setting the debt limit in terms of percentage of GDP rather than dollars, and making a number of other common sense reforms to make sure that we're focusing on managing the debt and not just political theatrics every time this debt limit needs to be raised.
Hey, James, appreciate your time. James Lucier there of Capital Alpha Partners, mentioning David Malpass, who was on this program the past week or so, making that argument.
And also, I think that a lot of Democrats would welcome this idea that you want to abolish the debt limit. It always ends up being this 11th hour deal. Financial markets care about it. They always end up raising it. But it's all this negotiation, backroom dealing for something that they know they're going to do. Trump wants to get rid of it. I will say, I think there is some individuals in Washington irked by the fact that they're dealing with this at the start of 2025, and the decks weren't cleared for Trump when he came in.
Everybody's a fiscal hawk when they're not in power. That's been the story of Washington, D.C. for the last couple of decades, that's for sure. In just a moment, about 20 minutes away, we're looking for numbers from JPMorgan, expecting earnings from them by about 7 a.m. Eastern time. Then after we get through the bank earnings through this morning, 4 big banks reporting, then we can shift our attention to CPI, inflation in America at 8:30 Eastern time. Going into that, equity futures positive here by 0.2% on the S&P 500, and bond yields just a little bit lower. Up next on the program, we'll catch up with Gerard Cassidy of RBC as earnings season kicks off on Wall Street. From New York, this is Bloomberg. Lots to get through, plenty to get through this morning. In the next 30 minutes or so, earnings from JPMorgan to kick off earnings season on Wall Street. Then later on, 2 hours from now, CPI in America. Your scores going into it look like this. 2 days of mild gains on the S&P 500, up again by just 0.2%. On the Nasdaq, up by 0.2. On a Russell, up by 0.4. The small caps helped out by this. Switch up the board, turn a page and get to the bond market story. 2-year, 10-year, 30-year. Yields down by 2 basis points, 477. We've had an 8-day run, Danny, 8 days where yields have not fallen on a 10-year Treasury.
And based on what I think is the important question here, because there seems to be percolating this idea that it's no longer about pricing out cuts. It's no longer just about economic strength, but that it's about pricing in some inflation. What inflation are we pricing in, John? Because prices paid rose on ISM, because just airlines were higher on PPI. The only thing you can really turn to is, do we not care about this current environment? And we're just looking forward to what happens after next week.
We were talking to Andrew Sheets moments ago, and you said something important, the price of uncertainty. This is something David Kelly of JPMorgan will talk about with us a little bit later. He believes the price of uncertainty, not knowing what these policies will be, is higher bond yields.
I've seen so much commentary saying the way that this bond market finally settles is post-inauguration when we have some certainty. That's an issue because there's this idea that unpredictability is a feature, not a bug of Trump's policy. So we might continue to have this era of uncertainty and then higher premiums that you need for that.
That was the buzzword in Palm Beach, unpredictable. He wants to keep everyone on their toes, not just adversaries and allies, but I'm sure also this market, whether it's the stock market or the bond market. So if you think just because he's swearing on a Bible Monday that we're going to have some sort of clarity, think again.
He's going to stay unpredictable for the next 4 years. Let's turn to foreign exchange. Euro dollar's a snooze, is going nowhere. 103.07. Sterling. They get some good news in the UK. Inflation comes in just a little bit softer than expected earlier on this morning. The pound 122.28. And dollar yen. Some yen strength here. Dollar yen 156.90. We had Mizuho's Jordan Rochester on the programme in the last week or so, and Jordan making the argument that he thinks the next BOJ meeting is a live one and that they might hike interest rates. And BOJ officials are starting to line up behind that idea.
But I wonder if they're even certain of it until after today and after the inauguration. This might be a Ueda who maybe wants to hike, wants to get that done, but isn't going to do it until we get figures from the U.S. and a greater clarity of what's happening in the political situation. It's what's dominating the yen. It's what's dominating gilts. It's what's dominating the pound. There is so much that hinges on the U.S. right now.
Dollar yen, 156.88. Under surveillance this morning, investors counting down to December's CPI at 8:30 Eastern Time. A Bloomberg survey showing the core print rising 0.3% alongside a 0.4% advance in the headline number. The data expected to boost the case for an extended pause in Fed rate cuts after the payrolls report on Friday put to bed the idea they'll be cutting rates anytime soon.
I think it's going to be an interesting litmus test for this market. Will bonds actually rally if we get in line or a little bit softer? If we don't rally, it could be this idea that we've been talking about, that we almost don't care about the present environment, that the present environment, as uncertain as it might be, is just a jumping off point for what we might get with more inflation. Ian Lingen over at BMO says that you need a much bigger downside surprise than just 0.2% in order to actually get treasuries rallying.
I wonder what kind of inflation print, though, we get that people start actually, instead of saying Fed's on pause this year, they start saying, ooh, the Fed might actually have to hike this year to tame inflation that we see. And that would go back to what Adam Posen told us last year, about 6 months ago, saying that was his big concern.
That's the latest on that front. More on inflation through the next 2 hours or so. The report drops at 8:30 Eastern Time. Wanted to get you up to speed on this story here. The SEC filing a lawsuit against Elon Musk, claiming Musk cheated Twitter shareholders out of more than $150 million by waiting too long to disclose his growing stake in the company as he prepared a takeover bid. Musk's lawyer saying the lawsuit is a sham and Musk did nothing wrong.
So basically what this comes down to, I believe, is a day. He had 10 days. He waited 11 to disclose this. What I find interesting, of course, is the timing. Chair Gensler is exiting, stage left, if you will, and then we're going to have Paul Atkins come in. And given the proximity that Elon Musk has to power, to the White House, to the president-elect, he's likely going to ask the incoming chair, you can imagine, to withdraw the case. So I still think this is a TBD situation.
Watch this space. Another story where we're waiting for a conclusion. I want to return to this. Returning Santa Ana winds and dry conditions threatening to expand wildfires across Los Angeles with more than 10 million people at risk. About 88,000 residents remaining under evacuation orders and almost 85,000 under warnings. Heather Zehr of AccuWeather joins us now for more to discuss. Heather, welcome to the programme. What is the latest on this front?
Hey, thank you and good morning. Well, so far the winds overnight have not been any stronger than they were during the day yesterday, which is to say that most of the wind gusts have been between 40 and 60 miles per hour. So that's good news and allowing a little bit better progress to be able to make in containment of those fires. The interesting thing with the wind has been that we've actually had around the Palisades fire offshore winds in the vicinity of Malibu that is blowing from the land out onto the ocean. However, on the eastern side of the fire, the wind has actually been a little bit onshore. So that's helped a little bit in firefighting efforts there.
So the wind is one thing and the expansion of these fires, Heather. What about just the starting of new fires? That's one of the features, unfortunately, that we've seen of this, that every place feels like a ground zero for a new fire. Are there more threats and more conditions that could cause that to happen? And again, just more growth in the area under stress?
Unfortunately, that is still the case for today. We are still expecting an extreme fire risk. It remains very dry. They've had very little rainfall over the course of, well, really since last May. They've had only 0.16 inches of rain in downtown Los Angeles since the beginning of October, which is considered the start of the wet season. Unfortunately, that has allowed the fuels that are prevalent after a couple of winters of good rainfall to be able to really dry out. Then you kick up these winds, you have very low relative humidity, and unfortunately it does lead to these extreme conditions where fires can easily start and quickly spread.
Heather, appreciate your time. Heather Zehr there of AccuWeather. The story to watch down in Los Angeles, and they're still waiting for a big break.
They are waiting for a big break, and just listening to Heather there, it doesn't sound like it will come from the rain. It's part of one of the really unfortunate things of what we've seen both in these wildfires and the other weather events we've had this year, is that because it's an unpredictable path, you have people that seem to be often caught off guard by this. Some of the sort of warning signs, the flags, the particularly dangerous situations that they issue don't really help. It's a little bit of confusion in how they actually communicate this. So the risks are still there, and it's people who maybe don't fully realize until this moment the calamity of just how big it could get.
We'll be following this story throughout this morning, of course, on Bloomberg TV and on Bloomberg Radio. Just turn back to the story in financial markets today, 8:30 Eastern time, we get inflation data. Before that, we get tons of bank earnings, including from JPMorgan and Wells Fargo, kicking off the big bank results on Wall Street in the next couple of moments. Both expected to report by 7 a.m. Eastern time. Gerard Cassidy of RBC joins us now for more. Gerard, welcome to the programme, sir. Love doing this with you every quarter. Let's look ahead to JPMorgan first. What are you focused on in the next few minutes?
I think what we're focused on is how strong the investment banking and capital markets businesses are for JPMorgan. But second, and maybe more important even that, John, is the net interest income guidance. As you know, in the fourth quarter, the banks like JPMorgan will give us the 2025 guidance. And I think the key number for the guidance number for JPMorgan Chase is going to be net interest income. And as you know, John, a positive slope yield curve is very positive for net interest income for all the banks, including JPMorgan.
Well, it is, to that point, Gerard, going to be the first time in almost 5 years that we have banks reporting results with lower rates already in hand. Is there any immediate impact that we will have seen from the cuts already done by the Fed?
I think there are. I think what you're going to find is that, of course, some of the earning asset yields will come down for loans that are tied to the short end of the curve, like a corporate loan. Partially offsetting that, however, is any of the fixed income instruments purchased in 2020 and 2021 as they roll over in the fourth, as they did roll over in the fourth quarter and will continue to roll over in 25 and 26. They'll roll over into higher yielding earning asset yields, even though the yields have come down from, of course, the highs of September. And then most importantly, funding costs, deposit costs, those are coming down. And I think what we're going to hear is that those costs may be coming down a little faster than expected.
So that's one portion. The other big bonanza we're expecting is trading. And on this, Bank of America's Moynihan had said that the firm's sales and trading team had its best ever quarter. Are we expecting that across Wall Street?
Generally, yes. The rising tide lifts all ships. And oftentimes, when one bank comes out and talks about the strength in trading, the others see it in their numbers as well. So I think you're going to find that we're going to have robust trading results for all of the big banks. And then the question is, how will that play out into 2025? And increased volatility, of course, is something that's always positive for trading results.
Gerard, stay close. We'll get a first look in just a moment, waiting for numbers from JPMorgan and Wells Fargo in the next few seconds. Look out for those numbers. Before we get them, we'll get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Israel and Hamas have reportedly agreed in principle to a draft ceasefire. CBS News cites Arab, U.S. and Israeli officials saying the deal could be finalized as soon as this week. Both President Joe Biden and President-elect Donald Trump earlier said they were optimistic a truce was close. Israeli officials say the first phase would include a 42-day ceasefire, the release of some Israeli hostages and Palestinian prisoners, and a buffer zone in the Gaza Strip. Meanwhile, UK inflation unexpectedly cooled in December, slowing for the first time in 3 months. The data calmed market jitters around the country's economy, sending yields lower, though they're still at elevated levels, while traders raised their bets on interest rate cuts this year. Meanwhile, South Korea President Yoon Suk-yeol has been arrested. Authorities launched a pre-dawn operation to bring the impeached leader in for questioning over his short-lived martial law declaration. The arrest came after Yoon repeatedly defied summons to appear for questioning. Investigators abandoned their first attempt to detain him on January 3rd after a nearly 6-hour standoff due to resistance from Yoon's security team. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, bank earnings on deck.
Overall, pricing is still very favorable for banks, which is going to allow the net interest margins to rally both in the quarter reported this week and next week, as well as what the outlook's going to be for the first half of the year.
Just around the corner, numbers from JPMorgan and Wells Fargo from New York City. You're watching Bloomberg TV. From New York City this morning. Good morning to you all. 8:30 Eastern time, so a few hours from now we'll get US CPI. Equity futures into that positive by about 0.25% on the S&P 500. Bond yields a little bit lower, down 2 or 3 basis points, 4.7657. Before we get to that inflation data, under surveillance this morning, bank earnings on deck.
Overall, pricing is still very favorable for banks, which is going to allow the net interest margins to rally both in the quarter reported this week and next week, as well as what the outlook's going to be for the first half of the year. So that combined with loan growth accelerating from the Fed data in the months of November, December is very positive for the sector at this point.
So here's the latest this morning. Big bank earnings kicking off today with results from JPMorgan and Wells Fargo due out momentarily. Standing by with us, Gerard Cassidy of RBC, Shanali Basak of Bloomberg alongside us as well. Gerard, I want to come across to you before we get these numbers from JPMorgan, and when they drop, I will jump in, so forgive me. I want to talk about succession planning, Gerard, and the news of the last 24 hours and how you reacted to that.
I think, John, it was not too surprising. Daniel Pinto, when he was moved over to this chief operating officer role a little over a year ago from the head of capital markets, we all knew he was, about the same age as Jamie Dimon, and he was really never considered the heir apparent. It was really Jen and Marianne Lake were the two, I think, leading horses, and now Jen, of course, is going to be the chief operating officer, and Marianne Lake runs the largest division of JPMorgan, or one of the most important divisions, which is the consumer banking business. And a couple of the other executives that are heading up the commercial and investment bank will also maybe consider heir apparents as well.
Gerard, still waiting for JPMorgan, but just getting Wells Fargo. So just hold on a second. I want to cross over to Manus Cranny for more. Good morning, Manus.
Hey, Jonathan. Good morning to you. It's a beat for Wells Fargo, $11.84 billion on the net interest income. The estimate out there was for 11.7. As you and Danny have been chatting about, this is about reporting in the first series of rate cuts that we've seen for 5 years. Charge-offs at Wells Fargo, which is always an interesting one, comes in at $1.21 billion. That is their net charge-offs. But the guidance for 2025 in terms of net interest income, and this is what the whole of the street is going to be looking at, is expected to be about 1 to 3% above 2020. 2024. So that's a comfortable beat on the net interest income at Wells Fargo and a guidance of 1 to 3% above 2024. Shall we dive into JPMorgan? We're just getting some of the numbers coming across the terminal now, Jonathan. We've got JPMorgan, the fourth quarter. I'm going to jump in straight to the charge-offs because it's pretty much in line. The charge-offs are $2.36 billion. The estimate, though, was for $2.39 billion. This is on JPMorgan. The fixed income sales and trading. This is the bulwark of what the street is going to focus on. We've got a number here of fixed income sales and trading, 2.04 billion. The estimate was for 2.32. So that is just a small skim lighter. Fixed income, FICC sales and trading revenue on the overall revenue side, 5.01 billion. So this is a blowout at the top level on the trading revenue, $5.01 billion. The estimate was for 4.37 billion. You had the election. You had good forms of volatility. FX volatility is ratcheting. It did the morning after the election. So a blowout on FICC. Diamond says unemployment remains relatively low. And this is the core to the bifurcation within the consumer. So a blowout at the top line on FICC are the details. I know that you're sitting there with Sonali and you'll go through them. Let me just give you the credit losses, 2.63 billion. So there's a couple of lines coming through. I'll hand it back to you with Jamie Dimon comments in terms of the flow and the health of the U.S. consumer. Jonathan.
Manus, thank you. Appreciate it, sir. Wells Fargo up in the pre-market. JPMorgan as well. JPMorgan higher by about 2%. Sonali alongside us to go through this. Sonali, what stands out to you?
A few things from the Wells Fargo perspective, just pointing this out because one big question has been loan growth, and they are expecting a growth in that NII this year alone. For JPMorgan, it is interesting. Fixed income blowing it out of the water, up to $5 billion for the quarter in fixed income and currencies trading over here. But you do have equities falling light of expectations. Now, what does that look like into this year? There's an expected IPO rebound that would lead to more supply here for the trading desks, but they are below expectations. Competitive business right now on Wall Street. Goldman is looking to take more share. They're looking to finance hedge funds in order to build that business even bigger. Morgan Stanley has been the king of the castle there, reporting tomorrow. We'll see what that rat race looks like. Charge-offs in line with expectations. At this part of the cycle, that's good news, isn't it?
Both stocks trading higher in the pre-market, not just about the numbers, also about the commentary. Manus was talking about it from Jamie Dimon of JPMorgan. The US economy has been resilient, unemployment remains relatively low, and consumer spending stayed healthy, including during the holiday season. Businesses are more optimistic about the economy, and they are encouraged by expectations for a more pro-growth agenda and improved collaboration between government and business. However, two significant risks remain. Ongoing and future spending requirements will likely be inflationary, and therefore inflation may persist for some time. And additionally, Anne-Marie, geopolitical conditions remain the most dangerous and complicated since World War II.
You can expect that from Jamie Dimon, who not just wants to be a bank CEO, but also likes to really opine about what's going on in the world, talking about the geopolitics, where we're going into a year where we still have two hot wars. We're going to have also some potentially tit for tat when it comes to trade, when it comes to China. And this idea of inflation higher. If you are a consumer, and even if you're in a University of Michigan, Democrat or Republican, you think expectations are going to be higher, that means this could end up being a self-fulfilling prophecy. But for these banks, Jamie Dimon previously, not in this earnings report, but previously said how they view Trump's victory was bankers, Jonathan, dancing in the street.
Stock is up by 2% this morning. Gerard Cassidy of RBC alongside us. Gerard, let's start with JPMorgan and look at FIG. Good. Equities, not so much. Gerard, what explains that?
I think, Jonathan, it really drives right to your comments a little earlier about what's happened to the 10-year government bond yield. I think what you see in trading is increased volatility leads to better trading results. And when you think about how the 10-year has behaved since the Fed started cutting rates back in September, that is, I think, a contributing factor. But also, the steepening of the yield curve also helps. But I think it's the volatility that drove the FIC numbers. And the equity markets, and the trading was a little light there, as you pointed out. And really, the trading, the equity markets, going into the end of the year, really didn't have the robustness that we saw throughout the year.
Gerard, can I go back to the comments from Jamie Dimon talking about a resilient U.S. economy, but bringing up fears both of geopolitics and inflation? It also rhymes with what we heard from David Solomon earlier in the week, saying that the economy is in a strong place, but it's fragile in this moment because of the same concerns. To how much are these comments tailored to an audience of one? How careful are these banking executives going to be, both in their statements and on earnings call, with the knowledge that perhaps it gets back to President-elect Donald Trump?
Not so much wondering if it's really directed toward the candidate or President Trump, but more these are global companies. I mean, big global companies, and so these types of uncertain times and unfortunate situations on what's going on in the Middle East and over in Ukraine really could have, if it really got out of hand, would really have a material impact on their global operations. But here in the United States, for the consumer on Main Street America, yes, we see it in the nightly news and it's very tragic, but it doesn't necessarily affect their day-to-day living. Inflation is far more important, impacting the consumer.
When it comes to regulation, though, and this idea of deregulation, the idea that Trump 2.0 is going to have a much lighter touch, especially in the banking sector, than, say, the Biden administration, Jamie Dimon talked about this, saying, regarding regulation, we have consistently said that regulation should be designed to effectively balance promoting economic growth and maintaining a safe and sound banking system. Gerard, how excited are the banks for this part, what they would call the good parts of Trump 2.0?
Very excited. I would suggest to you the resignation of the vice chair of safety and soundness last Monday. Michael Barr was a very positive event to have regulation less onerous for the banks. Basel III endgame, which is what it's referred to, was going to force the banks to carry considerably higher levels of capital, even though at the outset, when it was being designed, it was expected to be capital neutral. Now with him stepping aside, we do think the banks could see a capital neutral Basel III endgame, even though the capital levels for the banks are well above what they need to be. So I think as you look forward, they're going to replace the head of the controller of the currency, the FDIC, the head of the Consumer Financial Protection Bureau, and now Barr as well. And you look at Trump's first term, he had people in those seats that were much more realistic and business friendly and bank friendly. And I think that's going to be the case the second time around as well.
Hey, Gerard, appreciate your time, sir. Gerard Cassidy there of RBC. Just getting the outlook. 2025 net interest income, 94 billion. The estimate, Shanali, 91.31. That is a nice upside surprise there, and another tick higher in that stock.
Can I tell you something? The street was expecting this to be a lower number. So the fact that they came in at $94 billion expected this year. Guys, remember, this is a number that they have raised over and over and over again. This is the idea that you are not seeing interest rates lowering as much as expected, and you still have loan demand from consumers.
When we get this call a little bit later, 1/3 on the numbers, 1/3 on Trump, 1/3 on succession. Is that fair?
Yes, yes, and yes. Because one thing that has happened here with the Trump expectation is that, fine, lighter regulation means one thing. These companies have been hoarding capital in anticipation for those rules. So how much of that capital can be unlocked and how much of it goes right back in the hands of investors via share buybacks and dividends?
Shanali's going to stay close through the morning. A little bit later on, 35 minutes away, we'll get numbers from Goldman Sachs. After that, 30 minutes later, we should have numbers from Citi. Just getting numbers from JPMorgan in the last few moments. If you're looking at the trading side of things, FIC comes in strong, equities comes in light, but the outlook, Danny, the outlook looks pretty good.
The outlook does look good, and it's not even just net interest income. It's also a credit quality picture that's improving too. Both JPMorgan and Wells Fargo reported lower credit losses than estimated. So it overall looks like a bright and sunny environment.
Look out for the calls a little bit later. We'll see how bright and sunny Jamie Dimon's mood is on that call. The stock is up by 2.8% in the pre-market. Up next, Ken Leon of CFRA, Ed Yardeni of Yardeni Research, Jennifer Flitton of Invesco, and Greg Peters of PGIM, Fixed Income from New York City. This is Bloomberg.
Forward inflation readings will reassert the downward trend line, investors will be able to breathe a sigh of relief once again.
We got to see some sort of improvement in CPI as well for the bond market to really start to see yields push a little bit lower.
The inflation rate is not getting to 2%. There is an argument to be made that it is stalling at around, the high twos.
Inflation is probably going to stay sticky somewhere between 2 and 2.5%.
This is the issue we're all dealing with, economists, the market, the Fed. There are different details of the data you can look at and tell different stories.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So we've got an important 2 hours coming up. CPI at 8:30 Eastern Time. Before we get there, we've got numbers from Goldman Sachs in about 30 minutes' time. After that, numbers from Citi. Going into it and following numbers from JPMorgan and Wells Fargo. Equity futures up by 0.4% on the S&P 500. Similar move on the Nasdaq. Just to touch base with the bond market, yields are lower. Given a helping hand to risk this morning, we're down 3 basis points on a 10-year following 8 days without a single day of falling yields on a 10-year yield. 4.76. The numbers from JPMorgan, decent. From Wells Fargo. The outlook from Jamie Dimon, pretty good as well, Danny.
The outlook for net interest income in particular, very good. That could be maybe directly attributable to the fact of what this market is grappling with, that rates aren't going to be coming down as much as we thought. But it's as Lisa would say, it's not a toxic cocktail. She's not here. It is the perfect cocktail. It is a delicious cocktail of rates staying higher, of volatility in markets because of President Trump, so trading's good, M&A coming back because of President Trump, and deregulation that unlocks all this capital you can return to shareholders.
There is nothing toxic right now about this brew, which is why Lisa ultimately is on a ski slope somewhere over in Europe. But looking ahead, there are some questions and some risks. And Jamie Dimon acknowledging that in the release this morning. 2 significant risks remain. Ongoing and future spending requirements will likely be inflationary, and therefore inflation may persist for some time. Look at Washington. Additionally, geopolitical conditions remain the most dangerous and complicated since World War II.
And he goes on to say, as always, we hope for the best, but prepare the firm for a wide range of scenarios. And that is what everyone is doing right now. Donald J. Trump is going to be enacted as the 47th president of the United States on Monday, and everyone on Wall Street is preparing. He talked about also regulation. Everyone is excited about deregulation. In the past, he said Trump victory meant bankers were dancing in the street. But when it comes to things like fiscal spending, inflation rising, and how to deal with the geopolitics and the trade environment, especially when it comes to the tit for tat between Washington and Beijing, that's where everyone's eyes are going to be peeled.
Which is why these calls a little bit later, and we talked about this with Shanali, will be focused on 3 things, particularly with JPMorgan. 1 is the numbers, then 2 is the outlook, and that all hinges on what happens down in Washington. Then 3, it's succession planning at JPMorgan. It's just going to be back and forth all over the place on that earnings call a little bit later.
There seems to be this interesting idea is that maybe this is gamesmanship. Maybe if you are someone who wants to be the successor to Jamie Dimon, you need to come out and say, I don't want to be the successor. I just want to be his right-hand man. Because we have seen, John, time and time again, people who have been more vocal in wanting to be that next person, they haven't lasted at JPMorgan. I don't think we'll get into the nuance of that. Let's be very clear.
Are you suggesting that Jen Piepszak ruling herself out? That's what she's doing?
Well, it is a theory that by Piepszak rolling herself out, she is indeed making herself the most likely candidate.
JPMorgan's up this morning. We're up across the board. JPMorgan in the pre-market up by 2.6%. Wells Fargo is up by 2.4%. Equity futures doing okay as well. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research as JPMorgan kicks off bank earnings. Jennifer Flitton of Invesco with Trump's cabinet picks on Capitol Hill, and Greg Peters of PGIM Fixed Income as we count you all down to inflation data at 8:30 Eastern Time, about 86 minutes away. We begin this hour with stocks rising ahead of CPI data and better than expected results from both JPMorgan and from Wells Fargo. Joining us now to discuss is Ken Leon of CFRA. Ken, you've had about 15 minutes to pore over those numbers. What do you make of them?
Well, it's great. So we had outsized gains for these stocks last year. And what the results speak to is the ability to earn into your valuation. I would expect the street is going to have upward earnings revisions for 2025. Take a look at 2026. As noted here, what's the delta for driving that earnings? And that's about really for JPMorgan first would really be net interest income. So it's not just rates as noted here, but it's also volume, which speaks to the U.S. economy growing about 2.5%. Those 2 flywheels drives net interest income, which is significant for JPMorgan and other banks. The other delta that we haven't spoken about is investment banking, and it might start slow, but the ability of a risk-on environment for mergers and acquisitions and also equity underwriting means that we're going to be moving further up from the trough of the market or the cycle about 18 months ago. Additionally, when you look at, again, net interest income, but JPMorgan is a diversified bank, so it's getting that from many different types of services. The only negative here in the print was really community banks, a little bit slower in terms of their net revenue. But mostly this is a monolithic global bank, well-placed, trading at an expensive valuation. Our takeaway is stay the course, and they're going to grow into their earnings and valuation.
Ken, another figure, fourth quarter provisions for credit losses came in at $2.6 billion. The estimate was higher at just over $3 billion. Similar story for Wells, a lower number than expected too. What does that say to you about credit quality? Are we in a period or at least getting very close to normalization?
Yeah, for JPMorgan, then the industry. So bank analysts are a nervous lot, and the concern is always on credit risk and major write-offs. And so far, the economy is resilient. We're nowhere near an amber or red alert in terms of significant need for buildup of credit reserves. Looks like we're going to have a pretty good year for the economy. And when you look at the consumer, certainly as you do see increases in allowance for bad debt, it's mostly because the volumes are much higher today than they were 2 or 3 years ago. Ultimately, and we didn't speak about this, which is whether it's on credit risk or on trading, is that black swan event. So Jamie Dimon mentions geopolitical risk. The third I would ask is some liquidity squeeze in a complex trading product that upsets the market and maybe the bank stocks. We haven't seen it here. You know, if you go back in 2023, that was Credit Suisse.
Hey, Ken, appreciate your time. Before you go, we get Goldman in about 25 minutes' time. What kind of companies do you think we should be owning this year on the banking side within the sector? Do you think we need that higher capital market concentration or stick with the traditional names?
I'm believing in a strong delta here for Goldman Sachs. So we have a strong buy on Goldman Sachs. Only 15% of total net revenue comes from net interest income. So it's on fee service revenues across all its businesses. I like the announcement earlier in the week where they're trying to get a front row seat for private credit. John, we're going to be speaking about that more this year. I like where Goldman is. The rear mirror, of course, was the failed strategy with retail consumer banking. Goldman's going to do fine.
We'll spend more time talking about Goldman when those numbers drop at about 7:30 Eastern time, a little more than 20 minutes away. Ken, stick with us and stay close. Ken Leon there of CFRA. Joining us now to extend the conversation, Ed Yardeni of Yardeni Research. Ed, welcome back to the programme, sir.
Thank you.
Equity futures up by 0.4% on the S&P. Did these numbers from these banks give you the all clear on this economy?
I think so. I think the banks are very important. Usually bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. And they certainly do seem to be doing very well. The economy is growing. Loan demand is growing. And as you've been pointing out, we've got a new administration that's going to be easier on regulations. And as a result of deregulation, the banks are going to benefit from that. As a matter of fact, I think that the most obvious beneficiaries immediately from the new administration.
Ed, when you look at the overall market, it is easy to make the argument, as so many people do, is that it's overvalued. It's too expensive. Everybody wants to own the U.S.
Yeah.
Is the fact that banking is justifying some of these valuations, that they're pushing higher in their estimates, negate some of those arguments that we've heard to start this year?
Well, I think everybody believes that valuation is to a large extent determined by the interest rate situation, the inflation situation, and there's a big belief in reversion to the mean. And right now we've got the forward PE on the S&P 500 running around 22. The peak right before the tech wreck in 2000 was 25, so it's making everybody nervous. I think what drives the valuation multiples is the perception of how long the expansion is going to last. And we just had, over the past 3 years, the most widely anticipated recession of all times that didn't happen. And it made sense that we might have had a recession because the Fed tightened, but the economy's been resilient. And it, I think, demonstrates that it might be able to continue to grow right through the end of the decade. if that's the case, then earnings are going to, in fact, be able to grow and basically meet the expectations of some of these high PEs. So I'm not particularly concerned about that if the economy continues to grow, which I think it will, and if earnings continue to beat expectations, which I think it will, because I see productivity making a big comeback.
And you make a really good point. One of the key words you said there is grow through the next decade, because pricing in forward earnings isn't about next year. It is about the forward longer term outlook. Does that mean any of these gyrations you're seeing at the moment, be it from concern about fiscal policy, be it about where yields are today, that this is an equity market that can look through it because of the resilience for some time to come?
Yeah. Well, look, I think the big hurdle right now, or challenge for the stock market from going higher, is the bond market. Everybody's talking about 5% and maybe higher on the 10-year. The 30-year is basically just about there. And that's got everybody somewhat nervous. I mean, 5% is an awfully good yield, especially if inflation is going to be close to 2%. So we may see some rebalancing here out of stocks and into bonds. But all in all, with the economy likely to grow better than expected because of productivity, I think that's good for earnings, and that's good for the stock market. And I think it's going to take a little while here to get some clarity on what this administration's policies are going to add up to. But I think on balance, I'm optimistic that they will be positive for the market.
Well, that's one of the risks that Jamie Dimon talks about in this release. He says ongoing and future spending requirements will likely be inflationary, and therefore inflation may persist for some time. Ed, if this is the environment and inflation doesn't start to weaken the way we were trending down, is there a chance we could see the Fed have to come out and not just be on pause, but actually maybe hike?
Yeah, I started to hear people raising that possibility a month or two ago. We went from the market thinking several rate cuts at the end of last year, and that was fueled by comments from Fed Chair Jerome Powell that the 50 basis point cut back in September 18th for the federal funds rate was the beginning of several rate cuts, and they've started to walk it back, and now I think everybody expects a long pause. I think none and done this year. I don't think they're going to be raising interest rates. I think inflation may be a little sticky, maybe a little hotter at the beginning of the year, but I think it will continue to moderate because of productivity, because China is depressed. I think if we have an inflation problem from tariffs, it'll be sort of a one-off situation and won't be an ongoing inflation problem. So put it all together, and I think no, I don't think the Fed's going to be raising rates.
Just before you go, you coined the phrase bond vigilantes.
Yep.
We often talk about that. A lot of people are wondering whether they have actually returned, or whether we're just pricing in better growth, a better outlook for the US economy. And when I look at twos, and we'll look at where 10s are trading, the 2 years trading basically in line with Fed funds. The 10 years about 40 basis points north of that. That all looks fairly normal. Is there any evidence that the bond vigilantes are actually out in the United States and have made a comeback?
Well, I think you're making a good point, and it's not completely clear about the bond vigilantes, because the bond yield is actually back to normal, in my opinion. It's back to where it was before the great financial crisis, and let's take a wide range here of 4 to 5%. That's kind of where we are, and I think that's fine. But it's kind of the speed at which we get these things. I mean, back on September 16th, we were 3.65%, and now we're, everybody's talking about 5% as kind of the next stop. So I think that a lot of it is, in fact, better than expected growth and stickier than expected inflation. But this has all meant that the Fed's on pause, and the bond market has reacted to that. I do think there's some bond vigilantism out there. And I hope that Trump's advisors, like Scott Bessent, does what Robert Rubin did for Bill Clinton, and warn him that we need some fiscal discipline to avoid the bond vigilantes taking over law and order in the capital markets.
Yeah, well, we've not had much of that over the past few decades. Ed, appreciate your time, sir. Ed Yardeni of Yardeni Research on the bond market and the return potentially of the bond vigilantes. If you are just joining us, welcome to the programme. We had JPMorgan numbers come out about 25 minutes ago. The outlook, pretty decent, quite solid for 2025. And traders in the fourth quarter a record quarter. The stock is higher by about 1%. The gain's just fading a touch, though, in the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hakes. Hey, Yahara.
Hi, John. Southern California remains under severe fire threat. An army of firefighters spent yesterday putting out small fires before they got out of control. They also continued building containment lines on the larger Palisades and Eaton fires in hopes of preventing them from spreading. The fires are expected to be the most costly in U.S. history, destroying what officials estimate could be more than 12,000 structures, including many homes. Meanwhile, in China, the distressed developer Country Garden suffered another record loss in 2023. In the results, which were delayed, the builder blamed the loss on a huge impairment provision on properties under development and completed homes for sale. Country Garden says it still has more than 3,000 projects left to sell, with inventory worth more than $82 billion as of mid-2024. Meanwhile, Elon Musk's SpaceX has had another landmark launch. A Falcon 9 rocket with a pair of commercial satellites on board took off from the Kennedy Space Center overnight. Both satellites are carrying lunar rovers. One from Texas-based Firefly Aerospace will attempt a moon landing in 45 days. The other is owned by Tokyo's iSpace. It will try for its second trip to the moon after a failed attempt last April. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, Trump's nominees get a grilling on Capitol Hill.
What became very evident to us from the beginning, there was a coordinated smear campaign orchestrated in the media against us. It is time to give someone with dust on his boots the helm.
A conversation up next, live from New York this morning. Good morning. Bank earnings so far pretty good. Numbers from JPMorgan, from Wells Fargo as well. Goldman drop in about 12 minutes time. So equity futures rising by 0.4%. Bond yields a little bit lower. We're down 3 basis points, 476 later on this morning. 1 hour, 11 minutes away. CPI in America. Look out for that a little bit later this morning. Under surveillance, Trump's nominees get a grilling on Capitol Hill.
What became very evident to us from the beginning, there was a coordinated smear campaign orchestrated in the media against us. It is time to give someone with dust on his boots the helm. A change agent, someone with no vested interest in certain companies or specific programs or approved narratives. My only special interest is the warfighter.
So here's the latest this morning. President-elect Donald Trump's Pentagon pick, Pete Hegseth, appearing on course to win confirmation, dismissing accusations of past misconduct in his Senate hearing. Secretary of State nominee Marco Rubio among those speaking on Capitol Hill later on this morning. Then Treasury Secretary nominee Scott Bessent appearing on Thursday. Joining us now to discuss, Jennifer Flitton of Invesco. Jennifer, welcome back. Any reason to believe that some of these nominations might be in trouble? Any trouble at all?
Well, I think what we saw yesterday is that a lot depends on these hearings. And objectively, Pete Hegseth did a pretty good job, and it is now taking him on the path to confirmation. I think he'll skate through the committee approval, and he'll be on the floor probably sometime next week. The other more controversial folks like Tulsi Gabbard or Robert F. Kennedy Jr., I think these hearings are really going to matter. And if they have some of the same showing as Pete Hegseth did, then I think they're well on their way to confirmation.
Jennifer, if they're going up for the hearing, though, the Trump campaign must think that they have the votes for these individuals like Tulsi Gabbard and RFK Jr.
Well, I think they have faith in their strength, right? And one thing that is sort of a through line with all of these nominees is their strong ability to communicate, their ability to message and stay on message. And I think you're going to see that with Tulsi Gabbard and with Robert F. Kennedy Jr., with Patel for the FBI director. If they have strong showings at their hearings, and I think the faith there is with them from the transition, then I think they're well on their way to confirmation. And what we're hearing behind the scenes with the meetings that are happening with the senators is that they're gaining a lot of support as they move along.
It's a good point you make, because that's what sources close to Trump tell me, that being able to communicate his agenda is just as important as being able to do the job that he's putting some of these nominees in place. Can you give us a sense of what's so different from Trump 1.0 and how they worked with nominees and some undersecretaries and what we're seeing now? Are they moving faster now?
They're definitely moving faster. I mean, I think the vetting was a little slow because of how they decided to do it and when they brought in the FBI vetting and when they started filing with the Senate. But I think they're well within their way, well on the path to getting folks in immediately as soon as the president is inaugurated on day one. I do see a much sort of stronger bench in the sense of the ability of Trump and the Trump transition team, and really Susie Wiles at the top there as the chief of staff, to get folks in who are really speaking the message of Trump and Trump 2.0. I think in 1.0, you saw sort of, the mechanism in Washington really working to influence Trump. Now, Trump has a very strong position and has a whole team of folks who are there to push that position, to push that agenda.
Beyond just the ability to get these various cabinet members confirmed, Jennifer, does it also speak to a cohesion within the Republican Party that will benefit Trump as he tries to do things like pass one big, beautiful bill in a very slim majority? Does it help that these are getting through? Does it speak to that ability?
Yeah, absolutely. And I think we've seen it just in this transition period. Mar-a-Lago is a very busy place right now, and not just with CEOs from the tech industry. You see Washington basically flying down to Mar-a-Lago. He has been entertaining members of Congress, senators, entire caucuses and factions of the House of Representatives. I think going forward, especially within this first 6 months, you're going to see a very hands-on White House, really working their agenda and working with the members within the House who might be the most difficult to get on board.
Jennifer, appreciate your time. Jennifer Flitton there of Invesco. Just to build on that last point with regards to the tech sector, Mark Zuckerberg of Meta, in that podcast with Joe Rogan, took aim at the regulator on both sides of the Atlantic, particularly the Europeans, but talked about the United States and this administration giving them cover to go after them in places like Europe. It is intriguing to me that at the inauguration, you will see Zuckerberg, you will see Bezos, you will see Musk. And I wonder how this story is going to change and how much you're going to see the incoming administration support these national champions and then go after the European regulators that have been punishing them over the past few years.
Well, I think that's why you see Zuckerberg making these trips down to Mar-a-Lago, making sure he has a friend in the White House because of things like what he would call overregulation in Europe. They're not just showing up. Tara Palmieri reporting this morning that Zuckerberg is actually going to be hosting an inaugural ball reception for Trump and J.D. Vance with Miriam Eldison and some others. This is not just someone who's, I'm going to show up and quote unquote kiss the ring. I'm actually going to celebrate this.
Goldman numbers showing up, just getting them right now. Fourth quarter net revenue, 13.87 billion. The estimate, 12.37 billion. FIC coming in a little something like this. Let's look at how trading's been doing over at Goldman. Sales and trading revenue, 2.74. The estimate, 2.44. This is a cleaner read on capital markets activity. The stock is up in a pre-market by 3%. Danny, looking at the first read, it's a good read.
It's good, and it continues to be the trading bonanza. FIC coming in really strong, just like it did at JPMorgan. I'm going to be really interested in the look forward, though. What net interest income looks like, what they see for things like M&A with the new administration coming in.
So far, so good on Wall Street. Numbers from JPMorgan, decent. From Wells Fargo as well. And again, first look from Goldman too. Up next on the programme, we'll get some more analysis from Ken Leon of CFRA. And looking ahead to US inflation data, Greg Peters of PGIM from New York City. This is Bloomberg. 60 minutes away from US inflation data, 2 hours away from the opening bell, and equities with a little bit of a lift. We are higher this morning across the board, up by a third of 1% on the S&P 500. Similar move on the Nasdaq as well. Moments ago, we had numbers from Goldman Sachs, and Manus Cranny, those numbers are pretty good.
They are indeed, Jonathan. I think it carries through with this flex in FICC that you saw, first of all, in JPMorgan. Within Goldman Sachs, FICC comes in at $2.74 billion. That's quite significantly ahead of what was slated in the estimates at 2.44 on the investment bank as well. And if you think about the deregulation, the trough in investment banking that your guests have talked about this morning, this sets us up well for 2025. Investment banking, 2.06 billion. The estimate on the slate was 2 billion, but the fourth quarter comes in overall at 13.87. So it looks in this set of numbers, and you'll talk more about this with Sonali in a moment, it looks like the trading side on the equities in this story was a little bit stronger than the market had anticipated. Yes, still strong within the actual rates division. One small point here, Jonathan, that I would point out is on the advisory, fourth quarter advisory, 960 million. The market was looking for a number of over $1 billion. But then, of course, if you are at the trough and then the nadir in terms of IPO and capital markets business for last year, and the upswing is coming, then that's probably not much of a spoiler effect in these numbers. But fourth quarter net revenue, $13.87 billion. And the estimate on the street was 12.37. Flex and muscle for FICC across Wall Street.
Yeah, they're flexing hard, that's for sure. This morning, Manus, thank you. On the advisory story, of course, the hopes is that's going to change big time through the next 12 months, particularly under the incoming administration. I almost laughed, Sonali, when I read out that number. Fourth quarter revenue, $13.87 billion against an estimate of 12.37. That's pretty stunning.
It's a lot of money. And when you think about the equities trading side in particular, what's more stunning is they brought in $1 billion. I'm laughing. They brought in $1.5 billion more than Wall Street expected. JPMorgan came in light. That means they are gaining share. Part of this is coming from the way that they are financing. They have record financing fees and record equities fees here. Goldman is going back to being Goldman. They are beating at trading, in particular investment banking. No one's going to cry about being just under $1 billion, right? They are expecting that deal rebound and that underwriting rebound. You might have noticed they had created a new unit this week called Capital Solutions. That is telling the street that they are going to be on their front foot and make sure that their clients can go out and borrow as much as they'd like. So they are working on that underwriting, whether it's traditional way underwriting or whether it's through private markets.
A profit that doubles is really just stunning, Sonali. And so much of the strength coming already from an increase in M&A transactions, even before the expected boom we're going to see next year. How does this year, forgot what year we're in, how does this set us up for 2025?
You know, what's interesting to me is a couple days ago, I spoke to Goldman's co-head of M&A globally, and he said he's cautious still. And of course, there's still higher interest rates. They expect growth to be above 10%, 12, 15% maybe when it comes to M&A markets. So yes, a rebound, but still private equity hasn't really come back yet. That's going to be about valuations. That's going to be about the cost of financing. Interesting here, just for the Goldman story in particular, they are so close. They are just shy of their medium-term targets. So when it comes to return on equity and when it comes to what they're able to return in terms of profits, that's going to be the big question. Can they get sustainably over that 13, 14%?
Shirley, how much are all these bank earnings colored by politics, whether it's the volatility going into the election, out of the election, and then just the hopes and dreams of this really light regulatory touch from the Trump administration?
If you think about just how much these banks have risen since the election, it's extraordinary. And Goldman,
double digits.
In many parts of this market, you've seen Goldman shoot above its rivals because of that expectation. They have been number one in M&A for years on the league table. So in theory, at least that part of the rebound should be best for Goldman Sachs. Now, the rest of it, higher interest rates, you've been talking about this on the program a lot. If they stay that high, then doesn't it dent some activity? It was interesting to see JPMorgan come out this morning, not only raise net interest income expectations. Part of that is because they think auto loans are coming back. Now, remember, with longer-term interest rates higher, mortgages don't get down below 7%. And so, but many of these big banks are already not really doing much of that anyways, right? That's going to affect the regionals much more.
They haven't been in the mortgage business in quite the same way for quite a while. You mentioned JPMorgan, the outlook was decent. Wells Fargo, the numbers were good. The trading numbers out of Goldman this morning, pretty stunning. Any weakness here whatsoever across these three banks?
I'm going to answer that with just a little more strength. Because the thing that's surprising me about the Goldman numbers and JPMorgan, Goldman's headcount rose by 3%, while keeping expenses lower than expected. JPMorgan, in their statement, said that they will be investing in bankers and advisors across the country. They are hiring again. That is a story that we haven't seen for some time on Wall Street.
Goldman Sachs with some really, really stunning numbers across the board here, particularly overall net revenue beating by 13.87 billion against an estimate of 12.37, which is pretty stunning. The stock is up by 1.5% in the pre-market. Shanali will be with us again in about 25 minutes' time when numbers from Citi cross at 8 a.m. Eastern time. With us to discuss is Ken Leon of CFRA. Ken, 30 minutes ago, I asked you what's your favourite, what kind of business do you want to own, and you were loving Goldman Sachs. Do you love them a little bit more after those numbers?
We do. And I think there's a more dynamic story here for Goldman. They'll under-promise and over-deliver, I think, through most of 2025. The traditional businesses are going to get the benefits of positive trend. M&A, of course, with $1 trillion of private equity investments that have to be monetized in the next 24 months. CEO confidence is coming up. We're also seeing, with higher equity market values, great trading. But John, the story is, and if I was Goldman management, I'd be talking about their really pivot to having durable, recurring fee revenue businesses across. That would be in asset and wealth management. They're large businesses. And then also, as we see the easing of regulation in Washington, you're going to see Goldman be more of a principal actor besides just an agent for transactions. And what that means is getting to be more of a participant in direct private equity and private credit. We saw that as part of their announcement earlier in the week of blending some of these businesses so that they can partner or compete with Apollo, Ares, and others.
It is a different model, Ken, because for most of the big banks, the way that they've been approaching private credit is partnerships. Goldman, with that announcement, to your point, shows that they can compete with some of the big names. Which of the model for the banking sector do you think will ultimately win out?
Depends who you are, but I think Goldman can play offense. So they can certainly, as I said, be principal and compete. But also for asset-backed loans, they can also be there to also provide funding for the private equity firms. The traditional banks have a different game, particularly regionals or mid-size, which is really loans or syndicate loans competing against a corporate who wants to just get immediate attention with a direct borrowing from a private equity firm. And it's a sea change because it's moving up in size of the deals from small mid-sized companies to much larger deals over $1 billion. So it's a multi-year trend. I think Goldman, again, you have to go back over 10 years. Goldman couldn't be competing with Blackstone and KKR because of regulation. And we're going to see a little easing of regulation, but they're going to be smart because they want to have the right strategy and execute.
Ken, I want to go back to John's earlier point to Shanali. Do you see any weakness in any of these earnings?
The weakness is really related to any sharp change or shock in the markets that affects volume, but also affects in their books exposure. And I mentioned it at the hour before, which is really the black swan event. Some complex derivative product that has a ripple effect, whether it happens in Asia or Europe, but it impacts Goldman. Generally, the other one, which Jamie Dimon speaks to, is a geopolitical event. That has usually been, if there's any sell-off, a buying opportunity. But what we're seeing so far is confirmation that 2025 stayed the course, and we're going to see, I think, the consensus or street analysts raise their estimates as we go through the year.
It's the prudent thing to do to manage potential risk, Ken, but ultimately, I think what speaks louder than anything is the outlook from JPMorgan. The outlook's pretty decent. Geopolitics aside, incoming policy changes aside, the outlook's better than good, and the stock is up in a pre-market. I just want to finish with you, Ken, and look ahead to Citi. Numbers drop in about 21 minutes. You've had a decent read on a cross-section of Wall Street now. We've had numbers from Wells, from JPMorgan and Goldman. What should we expect from Citi in 20 minutes?
There's two things. First, they have the highest percentage of net interest income, over 70% of total net revenue. So we want to make sure there's a good print there. Second, from Jane Fraser, the CEO, is the ability to show that they're moving through on the transformation or restructuring, and we're actually seeing concrete evidence in the results.
Ken, appreciate your time. You'll be with us a little bit later. Ken Leon there of CFRA on some of the financials and the earnings we've had so far this morning. Shanali, just to cross over to you. When do these calls start and what questions have you got?
Well, JPMorgan has an analyst call first, or a media call. They talk to us first. I do want to know where they think the rubber will hit the road. Not only is Ken right with that black swan event, I could tell you from firsthand knowledge, I'm still talking to all of these executives about risks, and more risks. We were talking about how JPMorgan, they increased their value at risk for the equities book while their book had missed expectations. They took on more risk, bought in less revenue than expected over there. At equity markets, still pretty close to all-time highs. And then they were beat by Goldman in that same business. So there is still a lot of competition going on, and the banks want to scrape every dollar out of their balance sheet to make sure they're capturing that share.
Bank stocks up across the board. Equity futures elevated on the S&P as well. We're higher by 1/3 on the S&P. As I say, numbers from Citi in about 20 minutes' time. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Recapping those earnings, we're seeing a strong start to bank reporting season due to a trading bonanza. As Danny said, JPMorgan traders scoring their biggest fourth quarter haul ever. Meanwhile, Wells Fargo net interest income beat estimates, and it forecasts an increase for 2025. And at Goldman Sachs, earnings per share handily beating estimates, coming in at $11.95 per share, much higher than the $8.35 expected. Meanwhile, Donald Trump says he will create an external revenue service to collect tariffs on foreign imports. In a post on Truth Social, the president-elect says he'll set up the agency as soon as he takes office next week. Democrats and analysts have pointed out tariffs are already collected by U.S. Customs and Border Protection. And Meta is cutting roughly 5% of its staff. In a note to staff seen by Bloomberg, CEO Mark Zuckerberg says he's raising the bar and plans to, quote, move out low performers faster. Given its current staff, the move could affect roughly 3,600 jobs. Affected workers in the U.S. will be notified on February 10th, while workers in other countries will be informed at a later date. Meanwhile, new hires to fill those roles will take place later this year. That's your Bloomberg Brief. John?
Yahara, appreciate it. Thank you. More from Yahara in about 30 minutes' time. Changes at Meta, seen changes elsewhere. On the labour front, reports of JPMorgan saying get back to the office 5 times a week. Neil Dutta of Renmark saying these are not things that happen when the labour market is super, super tight.
It's not just them. It's also Citi saying they're capping 401k payments. Microsoft pausing hiring in their U.S. consulting unit. Southwest Air halting corporate hiring. It's happening in a lot of different industries, which presents this idea that the labor market's maybe not as strong as it seems on the surface.
Neil's not a worrier. I want to be clear about that. He really isn't. He is no perma-bear. He is usually constructive. He has some concerns about how this economy is going to start the year and finish it in 2025. Up next on the programme, US bond traders hoping for some relief.
We've seen a little bit of a relief rally in the bond market because the bond market really needed it. But we got to see some sort of improvement in CPI as well for the bond market to really start to see yields push a little bit lower.
That conversation up next, live from New York City. You're watching Bloomberg Surveillance. Stocks on the S&P 500, equities looking good, up by 0.4%. The bank earnings so far, so good. Numbers from JPMorgan, solid outlook from Wells Fargo, decent numbers from Goldman. Really, really strong on the trading side of the business. That stock is up in a pre-market. Next up for the bank earnings, we'll hear from Citi in about 15 minutes' time. Under surveillance this morning, US bond traders hoping for some relief.
We've seen a little bit of a relief rally in the bond market because the bond market really needed it. But we got to see some sort of improvement in CPI as well for the bond market to really start to see yields push a little bit lower. What's really affecting the 10-year portion of the curve is supply, the concern about Treasury supply, and not just because of future deficits, but because of prior deficits.
Here's the latest this morning. US bond yields moving lower ahead of the December CPI report due out in less than 1 hour. Greg Peters of PGIM writing, quarter-to-quarter fluctuations notwithstanding, odds favour, on balance, stable to lower yields ahead, which bodes well for fixed income returns, whether they come from carry or from total return. Greg is with us in the studio. Greg, good to see you.
Great to be
here. Good
here.
morning, sir. Thanks for being with us. Let's talk about this backup in bond yields. What's behind it? What do you think is driving it? We just heard from a guest there, Tom Tsatsouras from Strategas, who thinks that a lot of it's about supply. Do you think it is?
That's a piece of it. There's a multitude of factors, honestly, right? You have it's part growth, right? If you look at the move, it's mostly been real yields, right? So that's a growth change, which I don't quite fully comprehend. Some of it is productivity through AI and some other means. Some of it is supply through the deficit. Some of it is the policy uncertainty and factoring a little more inflation. So it's a combination of all those things, and kind of what's driving the move ultimately is the change in Fed. If you look at the pricing and probability of rate cuts and rate hikes, it's completely flipped. If you go back to September, the probability of a rate hike was virtually zero. Now it's almost 25%. So the fact that the front end is being repriced, that's allowing kind of yields to move higher across the curve. And this is a global phenomenon. That's the interesting part about it. It's not a U.S. story, it's a global story.
And we see it playing out worldwide, not just stateside. So if that's why you think yields are high, what gives you the confidence they're coming back down?
I just think it's a little far afield. Thinking about, we have CPI today and just inflation generally. I just don't really see the prospects of a rate hike here over the near term. What I think on balance, we're still in restrictive territory. I think ultimately the Fed, in this case, wants to get to neutral, which is a starting point of 4. And I just see kind of scope for that to move lower. And it just feels like a little overdone here.
But you pointed to the shift in the Fed, and I think that's a good point, because at the end of the last year, you had a Fed that was guiding the market to a certain destination. What feels like it's changed is that we're back to reactive Fed, a Fed that's very data point dependent. Does that not concern you? And what you're describing is that ability to get back down to a guiding Fed that's going somewhere lower.
I actually wish it was a data-driven market. It's the exact opposite. It's a potential policy-driven market, right? And if you're the Fed, how do you incorporate, tariffs, immigration, tax cuts, and deregulation? Some would bode for rate cuts. One would be actually hikes. So it's we're really beholden to policy here, which is not a great place from an investing standpoint, because investors ultimately like the data and want the data, and we're beholden to these factors that we don't really fully understand.
Well, then what happens if we have, for this year and the next 4 years, a Trump that is unpredictable in his policy, as we know he likes to be? What does that mean, not just for the Fed, but for markets that want that certainty? And a lot of market participants, let's be honest, who believe that they will get some form of it after next week.
Yeah, I'm surprised by that. To me, it's interesting. Investors seem to be amplifying the potential positives, which are, tax cuts, reforms, and deregulation, and completely dismissing the negatives, right, of tariffs and the impact of immigration. So to me, it's very much of a trust me trade, particularly as we enter next week, because the items that are more market negative are immediate, right, and they don't require congressional approval or involvement. The items that are actually more impactful from a positive standpoint from the market require Congress and other items, and that's going to be harder and it's going to take longer. And so we're going to be in this vacuum, I think, where the negativity is up front and we're waiting for the positivity. And I'm surprised that the markets are taking it so well. My suspicion is that the markets will continue to be quite volatile as a result, though.
Jamie Dimon leaned into these two risks, one being geopolitical, the other being what happens on the fiscal front. And he talks about inflation basically persist for some time. Do you foresee that under a Trump administration?
I do. Everywhere I look, I see more inflation, not less inflation. And so even though the CPI print is important today, it almost misses the point, because so much policy is on the come and changing. That's potentially inflationary. But you look at onshoring, nearshoring, friendshoring, that's all inflationary. You look at tariffs, it's inflationary. You just look at kind of the growth dynamics, it's inflationary. You look at immigration policy becoming more restrictive, it's inflationary. So I'm with Jamie on this one. I think we're out of the zone of disinflation, and I think inflation will be stable to, if anything, slightly higher.
The Fed would talk about inflation trending down. They want to get at a 2% target. How far off are we from that?
I don't see 2% anytime soon, honestly. It's important to remember that 2% is a made-up number, though, right? So there's no magic around that 2%. But But my strong suspicion is that we'll be above that 2% for quite some time. And that's okay, actually, right? If it comes with growth, the challenge is if you have this stagflationary type of backdrop, that's the one that we really worry about for bond investors and just kind of investors broadly.
We spoke to your old protege, Andrew Sheets of Morgan Stanley, a little bit earlier this morning. We talked to him about how strong corporate balance sheets were and whether they could handle this environment. If you are expecting a more inflationary environment or sticky inflation, do you think corporations have the power to pass on price hikes in the way that they did a couple of years ago?
Well, it's been really surprising. Margins have been really sticky on the high side. So I've been calling for margin decline for, I think, 7 years or so now. And, I'm still waiting. But I think on the margin, you will see, no pun intended, you will see it come down. But the pricing power is actually quite strong, quite real. My suspicion there is that some of it will be absorbed through margins, but a lot of it will be passed on to consumers. And then consumers also have the option of moving away from those products into cheaper products, and that's what we saw in the tariffs last time.
This is going to keep interest rates higher for longer than we certainly expected. A phrase that we mentioned earlier on the programme was survive until 25. There were certain companies that were trying to survive until 25. Fed was going to cut rates, things would be okay. Doesn't look like they are anytime soon. Who's in trouble? Which parts of fixed income wouldn't you touch right now with that in mind?
The challenge that I find is that valuations are priced for perfection. So I look at credit as an example. I think the credit markets are in pretty good shape fundamentally, as Andrew mentioned. Balance sheets are strong, cash flows are high. You have parts of leverage in the system for sure, but it points to a strong macro. My challenge is that it's priced that way and then some. And so I look at the fixed income markets, I look at the equity markets, and the concern I have is that we're pricing in this productivity miracle, which is down the road, on the come for sure, and the immediacy of that impact is, I think, quite disappointing.
What it sounds like, and you can correct me if this is the wrong interpretation, you seem to have more relative confidence in treasuries right now than you do in corporate credit. Is that fair? Is that the wrong interpretation?
I slightly agree with that, I guess, in a way. So
I'm running with it.
That's why I'm here. But my concern is that the credit spread that you get it's just negatively convex, right? So if in fact you are wrong around the economy, then that benefit really goes away, right? So the extra spread that you're getting, which is quite paltry, it's like the richest decile that we've seen over the past 30 years. You're just not really getting paid for that risk. So yeah, all else equal, I'd rather have duration risk in my portfolio because it provides that ballast, that balance. If things do go pear-shaped economically, you have that duration. If you have that duration in credit, you're fighting kind of the weakness in the economy through the credit spreads, and you're not getting that duration benefit.
Smart. It's always good to see you, particularly in person. Thank you, sir. Greg Pittis there of PGIM Fixed Income. On fixed income, looking ahead to US CPI. Inflation data 34 minutes away. In about 4 minutes' time, we also get numbers from Citigroup, so look out for that. We'll be catching up with Peter Tchir of Academy, David Kelly of JPMorgan Asset Management, and Aditya Bhave of Bank of America Global Research. From New York, the third hour of Bloomberg Surveillance is just around the corner.
We've had some reports on inflation and inflation expectations, which weren't great. If that continues, that could cause the consumer to pull back.
With inflation sticky, growth strong, we just didn't see scope for the Fed to be cutting rates this year.
Inflation will be sticky. We'll basically be living with a high inflation target.
In our view, slowly but surely, it is heading close to 2%.
What we're seeing right now is the biggest catch-up in history between soft data and hard data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So we've got a lot to get through this hour. In 30 minutes' time, we get US inflation data, an absolutely stacked hour ahead of us. Before we get there, we need to talk about more banks. Equity futures at the moment elevated by a third of 1% on the S&P. On the Nasdaq 100, up by 0.4. We've had numbers from JPMorgan. The outlook was good. Numbers from Wells Fargo, decent. Numbers from Goldman Sachs, the trading numbers absolutely stellar. And just moments ago, numbers from Citi. With the latest, here's Manus Cranny.
Jonathan, it's a quartet of good news, and it's a triptych in FICC. Citi has delivered FICC sales and trading of $3.48 billion. The estimate was just under $3 billion at 2.94. So that just shows you, again, the musculature of FICC, the good vol that you had in that fourth quarter into the election and afterwards, post that jumbo rate cut from the Fed. Buyback, $20 billion. This was the missing piece in the chessboard, according to some of the analysts. It was a slight promise by the bank just before Christmas in terms of the narrative from there. Mark Mason hinted that this would be. So $20 billion in a buyback. FICC is a comfortable blowout. And investment banking revenue, $925 million. And again, this is what the market was hoping for, is that renaissance, that change that Jane Fraser has enacted across this bank would be rewarded. Investment banking, $925. The market was looking for $896. So that's a comfortable read for Jane Fraser at Citi this morning. Jonathan.
Manus Cranny, thank you. Citi up by 2.4% in the pre-market. Shanali Bassett with us around the table. Shanali, is that a clean sweep this morning? Decent across the board here?
The numbers themselves are very decent. You have them beating on fixed income and trading revenue. You have really strong results here in terms of net interest income as well, above expectations. What investors will also be looking at, John, though, remember, this is a bank that's in the middle of a turnaround story. They did lower their return on tangible common equity targets. The new target for 2026 is now expected to be between 10 and 11%. That used to be higher, between, let me tell you exactly, it used to be between 10 and 12%, I believe. Yes, 11 and 12%. So they are lowering that for next year. By comparison, Goldman is expected to be bringing up in the medium term above 14%. JPMorgan puts up 17% like it's no problem every quarter, right? So that is going to be the number for Citigroup that investors are going to be looking to, because really, with regulatory hurdles that Citi still faces, how can they keep their expenses in line to bring profitability up as they go through this turnaround story?
That I find interesting, that at least for the moment, we are able to get it some decent of a rally, despite the fact that they lowered their return on tangible equity goal, because this had been such a big thing for them. Mike Mayo had said that he didn't think they'd get to their 12% target until 2027. Are moving the goalposts, is this something that investors will be okay with Jane Fraser, who is just so under pressure right now?
Listen, the answer is maybe, because at least you know where they're going now. They're giving you credible targets in terms of what they need to put out the door and what they're going to bring in the door, while, by the way, beating on expectations with the revenue they're bringing in. If they're bringing in revenue and they're showing that they're steadily beating, then maybe it's okay. The point that you made earlier, John, about Jenny, you made it, about the models, the business models. They could take on less risk while they partner with private credit firms to bring money in the door and gain client share. They have a new head of investment banking. I think you guys are talking to him very, very soon as well. That will change the game for Citigroup. But remember, the other story for this, too, is they're the cheapest. You have JPMorgan and Goldman Sachs, each trading well above 2 times book value. Citigroup is still well below that. They've made progress, but they have a gap to close here, and investors are looking for them to do it.
Offering some headlines on the outlook here. Let me go through them, Shanali, just briefly. So for revenue for 2025, a range of 83.5 billion to 84.5. The estimate was 83.2. For net interest income, ex-markets, to grow in 2025 modestly. To your point, does that do enough to offset this morning, just rolling back the profit target just a little bit?
The modestly part is a little hard when JPMorgan an hour or two ago said that they're going to bring in $1 billion more in net interest income. They both have massive card businesses. When you hear Mark Mason, the CFO, talk to journalists shortly, but also both of them, Jane and Mark, will talk to analysts soon too. Do they see something different in terms of credit quality? Are they more cautious than their large rival, JPMorgan? Is part of this pressures internationally? Remember, Citigroup has that special concern that a lot of other banks don't have as much of. This is the question.
Shanali, appreciate your time this morning. Lots to work through. Look out for more from Shanali in about 55 minutes' time when she leads the show into the opening bell alongside Matt Miller and Katie Greifeld. Ken Leon of CFRA is still with us. Ken, we spoke to you about 30 minutes ago. I'm going to say this for you. You gave Goldman Sachs an A+. What does Citi get this morning?
Well, we'll give them a B. I haven't seen the details, but picking up from what Shanali said, the return on equity narrowing the range, they took a $1 billion restructuring charge in 24. So the ability possibly to reduce costs, or more than the street thinks, might be able to help them on ROE. Citi is also an event-driven stock of the large banks. They are finally this year, we hope, moving to monetizing, selling in Mexico, Banamex, which was by far the largest consumer bank they had outside the U.S. So that's significant. It's event-driven. They also have stable businesses with more transparency. That's called services. It's treasury and trade solutions, a dominant position in the corporate treasury market. And certainly they're more on the fixed income side versus equity across banking and trading. So I think Citi's going to be fine, and they're still trading below net tangible book value, although the gap has narrowed a bit. So we need to see results improve through 2025. But I think myself and most analysts with buys think that they can execute. Jane Fraser is still on course.
She's still on course. That gap maybe even narrowing more this morning with the rally still ongoing pre-market. Ken, another headline that came out is that they see their expenses for 2025 slightly lower than $53.8 billion. That is the high end of their range that they had already given to this market. Does it concern you that they aren't bringing in expenses quicker in the midst of this restructuring?
Well, it ties in with my earlier point, a $1 billion restructuring, but what they're doing is reducing management layers and also realigning businesses that weren't really responsive to the markets or customers. So I think it's a timing issue, and one where you'll see accelerated improvement perhaps in the second half of the year, but you'll see improvement. But it just doesn't happen in 1 or 2 quarters.
Hey, Ken, appreciate your time. Thanks for this morning. Ken Leon there of CFRA on Citi. That stock is up by 3.6%. So we've had numbers from JPMorgan, from Citi, from Goldman and Wells Fargo. Tomorrow, we'll hear from Bank of America and from Morgan Stanley. Equity futures this morning, more broadly, up just a little bit, going into a huge data point in about 20 minutes' time. Coming up this hour, we'll catch up with Peter Tchir of Academy Securities, counting down to CPI, David Kelly of JPMorgan Asset Management on why he thinks inflation will slowly tick lower over 2025, and Aditya Bhave of Bank of America Global Research expecting the Fed to stay on hold all year. We begin this hour with stock steady. Investors are waiting CPI due out in just under 30 minutes' time. Peter Tchir of Academy Securities weighing in on the month's data so far, saying this: what if markets reacted so poorly to payrolls because no one believes the data? But everyone believes that the Fed will need to react to the data. The Fed is forced to rely on official data, but the data isn't reflective of reality. Does that lead to policy mistakes? Peter joins us now for more. Pete, good morning to you, sir.
Good morning.
I love this quote over the weekend. I shared it with the audience as we kicked off the trading week. Are you suggesting the number we got on Friday overstates reality?
I do think so. And, part of me, I just look. 75 economists submitted to the Bloomberg survey. 74 were under. Only 4 out of the 75 were over 200 jobs. So they missed by a lot. So either we have to believe the official data is so much better than all these smart people with their resources figured out, or the official data might be wrong. And certainly the trend for the last 2 years has been the data has been overstated, especially in January, February. So I think that's where we're in this awkward position. No one really trusts the data. The economy doesn't feel that strong, yet the Fed seems to be responding to that.
So good news with an asterisk is bad news?
I think so, if you don't believe it. Again, I think CPIs might play out the other way, where I think people are starting to believe CPI has been understated. And so as it starts catching back up, the Fed's going to have to react to that. So I think the Fed's caught themselves in this kind of quandary where they missed a lot of it. You go back even to CPI. They were talking about housing, and they missed housing on the way up because the official data took time to reflect what was going on in rent. They've been missing it on the way back down, but now it's all normalizing. So I think this is a big disconnect where everyone in the markets is trying to figure out what the economy really looks like. And then what's this data-dependent Fed going to do if they're relying on the official data, which people seem to question more and more?
Isn't this, though, a bit of hubris on the part of markets to suspect that they know the data better than the Fed does? Why would the market have a better insight into it than the Federal Reserve, than the FOMC? Would they not have some understanding that perhaps the data is skewed too?
So I would say maybe 10, 20 years ago, the BLS had more computers than everyone else, right? People have AI. People have access to all sorts of data, right? These economists are using AI. They're using all sorts of tools, whereas the BLS has a lot of rules they have to follow. So it's pretty prescribed, right? They chose, for example, to use COVID period in their seasonal adjustments. So kind of whenever I look at charts, I try and wipe out the COVID years because it was so much noise. Mm-hmm. So it's things like that I think maybe people have taken some time, aren't bound by rules, or actually getting closer. And ADP, which should, in theory, probably have pretty good real-time data, came nowhere close to the official NFP either. So those are the questions I think everyone has to ask. Problem is, even if you had the exact right number, you're still going to have to trade off what the market comes up with.
How much noise is political uncertainty making?
I think a lot. I think, Greg Peters talked a little bit about this, even looking at bank earnings and everything kind of going forward. A lot could change in the next 2 months. So, we are sitting there watching. Part of it, I think we probably have a beat on CPI. So CPI comes in higher, partly because I think people have been buying things ahead of potential tariffs. So you're seeing demand pulled forward by these tariff fears. And we'll go through a lot of information in the coming weeks of what does Trump really want to do? What can he get done? In terms of tax cuts, I think people have been overplaying that a little bit. To me, just keeping the tax on isn't a tax cut, right? If everyone's not going to change their spending, no one that I know is thinking I'm going to have to pay higher taxes.
To be fair, though, it is a tax cut if I believe that 4 months ago someone else was going to win this election and I thought taxes were going up.
That's fair. And I think if they get the SALT deduction, that would be a official tax cut. But I think people have been a little bit optimistic on these things.
You mentioned the bank earnings. I want to cross over to Sonali again and bring you back into the conversation because the media earnings call just kicked off with JPMorgan. And about an hour ago, we said that this call would be 1/3 on the numbers, 1/3 on the Trump administration, and 1/3 on succession. Jamie Dimon had this to say on the earnings call. Management changes in the last day don't change the succession timeline at all. Now, I'm not familiar with a timeline. Are you familiar with the timeline for succession at JPMorgan?
All I know is that he stopped saying 5 years. So there is no succession timeline. In fact, I love Mike Mayo's note about this. He goes, I'm confused on who the next successor is if Jen Pipsack takes herself out of the race.
Do you think we're getting closer to the point where it becomes a problem? Because this is an individual widely celebrated by Wall Street. It doesn't appear to be a problem for the stock. It's trading near a record high. How close are we to this becoming an issue?
It's speaking of inflation, you know what I love about Wall Street? We're in the second week of January. Goldman Sachs already, JPMorgan, and now you're seeing changes at BlackRock as well. People out the door and people up the ranks. And so you better give them another title if you can't pay them much, much more right now, because right now people are asking for more. And you have to keep the next generation happy if they can't rise as high as the CEO spot.
That earnings media call just underway. Any more headlines, we'll bring them to you. Sonali, thanks again for this morning. Peter Tchir is going to be sticking with us. Going through to CPI, inflation data is about 17 minutes away. Equity futures into that higher by 1/3 on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Staying on those banks' earnings season on Wall Street, kicking off on a high note. JPMorgan traders scoring their biggest fourth quarter haul ever, while Wells Fargo net interest income beat estimates, and it forecasts an increase for 2025. At Goldman Sachs, earnings per share came in at $11.95 per share, much higher than the $8.35 forecast. And Citi, rounding out bank earnings for the day, posting markets revenue that beat estimates and announcing a $20 billion stock buyback. Shares are up 3.8% in the pre-market. Meanwhile, Southern California faced another night of extremely critical fire conditions due to high winds and minimal humidity, leaving 10 million people at risk. The fires have already claimed the lives of at least 24 people and have burned down more than 12,000 buildings, including many homes. And the Washington Post reporting Elon Musk will be joined by Jeff Bezos and Mark Zuckerberg at President-elect Donald Trump's inauguration on Monday. The three tech moguls will sit on the dais alongside former presidents, Trump's family, cabinet picks, and lawmakers. That's according to a Trump official who spoke to the paper on the condition of anonymity. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next 30 minutes or so. Up next, the morning calls. And later, David Kelly of JPMorgan Asset Management and Aditya Bhave, Bank of America, reacting to CPI. Aditya and the team over at BofA more recently dropping their call for any rate cuts in 2025. That debate is just around the corner. From New York, this is Bloomberg. So this is the setup going into CPI in just a moment. Inflation data just around the corner, and equity futures at the moment up by 1/3. In the bond market, things calm down a little bit. Yields are lower by 3 basis points. The 10-year 475.75, and I should stress this can all change in about 10 minutes' time. Time now for some morning calls. First up, Bank of America cutting its price target on BlackRock to $11.94, citing declining month-over-month net flows. That stock is still positive by 3.2%. Your second call from JPMorgan raising its price target on Deere to $4.70, saying it's in a good place to hide if the macro narrative turns worse. That stock is up by 0.1%. And finally, Barclays raising its price target on Tesla to $3.25, saying its narrative command has gone into hyperdrive since the US elections. That stock is up by another 0.75%. With inflation data just around the corner and inauguration 5 days away, Peter Tchir of Academy Securities is still with us. Pete, let's start there. Inauguration, that is for many people the most important data point of the month. What kind of changes are you expecting on day one?
So I think markets might be a little complacent on the tariff side. I do think he's going to start off slow, but from people who worked with Trump under the past administration, he really does feel that Xi did not live up to his promise to buy U.S. ag goods. So I think there's a degree of caution with Trump and a lack of trust with him towards Xi that I think may yet play out. So I think we're going to see a little bit more bumpiness from the tariffs. So I think that's probably a negative. I think on the immigration side, I'm fairly comfortable Trump's going to go more for what we're calling easy wins. Pick and identify targets. Maybe it's something like the Roosevelt Hotel that's kind of grown onto a life of its own, the criminal organizations in some of these cities, and kind of this law and order. So we don't see this devolving into some sort of door kicking, pulling people out of restaurants. I think he's been told by the Chamber of Commerce, by a lot of small business people, leave the good migrants alone. Let them work. So go some high-profile wins. So I don't think that's going to be too disruptive. And I think we actually see some good news on the geopolitical front. I think Iran is back on their heels. Israel's prosecuted the war so well that we, from a military standpoint, that they've knocked them back. And so we think there's a possibility there. And the rest of the Middle East is really trying to move on to westernize their economy. And I think there's a decent chance he pulls off some sort of negotiated settlement with Russia and Ukraine.
So 3 topics there. One was trade, the other immigration, and finally on geopolitics. Can I just go to trade first of all? Whose approach do you think that the incoming president is going to run with? Is this going to be the Treasury Secretary designate Scott Bessent, incrementally negotiate, 2 here, 5 there, month on month? What kind of approach are you expecting?
I think he's going to start that. And again, part of this depends how many easy wins he gets, right? If he wins on some immigration issues early on, maybe he can afford to be that. If he feels like he's not getting on immigration, then he'll go for a bigger, more aggressive play on that. One thing we've been watching very closely is his change on TikTok, right? So to me, TikTok was very interesting because you had bipartisan agreement that China had to sell, and Trump seems to be walking that back a little bit. So to the extent we all thought there was going to be this real degree of friction between Trump and China, it's a little bit concerning to me that he's all of a sudden, TikTok might be okay, and you can't tell whether he likes TikTok because TikTok's good for him, or whether he's just not concerned, or whether he hasn't been read the riot act once national security truly gets into him.
Well, speaking of TikTok, they're going to make a huge splash this weekend, potentially just pulling the plug according to the information on Sunday. How much is TikTok now potentially a negotiating tool for the Chinese, based off our reporting that they're willing to hand over the reins if it's Elon Musk and handpicked who could basically take on this company with Trump's trade negotiations?
And I think that was an interesting play by them because of all people, I think Elon Musk has been great, but do you want him having control of yet another media outlet? So I think they're throwing kind of a wrench in this, right? It's if you didn't own Twitter or X,
issues.
Right. So it's kind of interesting. That's where we're really watching. I think in the end, we start seeing more pressure on China that once he becomes president, once he's kind of fully every single day forced to listen to national security people, I think we redevelop that friction. And the things that Biden's been doing this last few weeks in terms of, chips, I think that just continues. I think there's going to be real high-tech pressure with us in China. I don't think that's getting better. I think our economies are continuing to drift apart. And we might get some short-term deals that let that work. But I think longer-term, China's trying to work with the autocratic, resource-rich nations. They're trying to sell their brands there, and we're separating from them. We're going to have to figure it out. And we're going to bring a lot of things home. And we're going to do a lot of, not just drill, baby, drill, but I think it hasn't caught on refine, baby, refine. But we're going to do a lot more extraction of resources and the processing because China still processes over 90% of the world's rare earths and critical minerals. We have to have a decent subset of that done domestically or with close friends.
As we get some of this coming in, as we get the various headlines of him going after China, of the tariffs he's going to put on, how do you understand the market's ability to actually react and absorb it? Because to your point, at the moment they haven't. it's a market that's been interpreting things as positive. It looks at 2 to 5% incremental increases in tariffs and says that's a good thing. Is this a market that just will continue to discount any of the negativity?
Well, the bond market's certainly been looking a bit the other way. The bond market's been going worse every day. They're looking at some of these things. We're seeing inflation everywhere. Equities have been a little bit disjointed from that. You are starting to see some of the value come through. I think it's going to be a great year to be an investment bank because I think you are going to get increased volatility in bonds and equities. And, again, I always view that Trump likes to create noise. Our theme of 2025 is it's going to be messy. Anytime you think things are going to be really good and smooth, expect some noise the other way. And every time you think it's going to be this disaster, expect some reassuring comments. So that's how we're trying to trade this. It's still hard, but it's like just expect Trump to do the unexpected, if that makes any sense.
What's your favorite investment idea off the back of all this?
Right now, I do like anything that's going to be part of this refining process or processing. So I think a lot of the big equipment manufacturers, and it's almost scared to say, but I do like a overweight in commercial real estate. I think commercial real estate is going to be one of the big beneficiaries of this whole year.
What kind of commercial real estate?
I think office, big cities is fine. I think the work from home is almost done. I think by the end of this year, we're going to be 4.5 days, which means maybe you get every second Friday work from home. There's this huge push. And what I like to see is kind of, again, we mentioned earlier, this return to law and order. Okay, shoplifting is now a crime that's being punished again.
Sure.
You've seen Mayor Adams change a lot. I think various cities are looking at this various ways, but I think you start rebuilding that downtown core. To me, it's still half insane that every federal employee is still work from home. Musk will change that. Watch for resurgence in downtown D.C. as, yes, there will be some job losses, but those buildings will start filling up. The bottom floors will start reopening with the Starbucks and all the other stores that go in there.
So you see a net positive from that call?
I do. I think it's going to be, in 2 years, we're going to kind of forget a lot of this work from, home type thing. And again, I think it's even coming with younger employees. They want to be mentored. They're realizing this is hard to have career growth if I'm not in the office.
This is a big vibe shift that we're seeing in corporate America. We're seeing this across various companies right now. Do you think it's ending virtue signaling or replacing it with a different kind of virtue signaling or actually getting back to core competency? How do you see it?
I think for the last 2 years, every CEO was banging on the table wanting people, and he was being told by HR, you can't do that. People will quit. People won't. And as it starts fulfilling, I think this has just been pent up. Like, no one's wanted to no CEO or very few CEOs have wanted this to go on.
Yeah.
I think San Fran's going to be a slightly different area only because those companies in and around there they benefit from the work from home. So I'm not sure they're going to push people to the office. I think San Fran still has not yet cracked down on crime, so that's going to be an issue. So maybe you want there. I'm a little bit worried because I think on rates, we're not going to get as much help from commercial real estate. And some of the properties still probably need to be revalued. But I think that's going to be the big surprise is everyone pushes for this work from office. You start seeing things rebuild. You see around here, the bottom floors start reopening. Stores in there, places to eat. I'm excited for that.
Anne-Marie said it last week. 2 CEOs. One's the head of HR. The other one's the actual CEO.
And I think in 2025, the HR CEO is going to be in the back of the bus.
Taking a long vacation, working from home maybe. Who knows? Not ours, love ours. Peter Tchir of Academy. Don't want to cross them, Pete.
No.
Don't want to cross them. Appreciate it, Pete. Thank you. Inflation data up next. Danny, stay out of it. Equities up on the S&P. Smart thing to do. Up by 0.4% on the S&P 500. Inflation data up next. So here it comes, the big data point of the week. US inflation data just around the corner, 20 seconds away. Going into it, your scores look like this in the equity market. Futures positive by 0.4%. On the Nasdaq 100, up by a similar amount, up by 0.37. In the bond market, after 8 consecutive days, an 8-day run of yields not dropping on a 10-year, they are dropping this morning by 5 basis points. Your yield, 474.93. Your economic data looks like this. Here's Mike McKee. Good morning, Mike.
Good morning. Well, it looked like economists have done their job again because we're coming in almost bang on the numbers with the CPI up 0.4 during the month of December. That's a tick higher than in November, and it is right on with the consensus on a year-over-year basis, puts us at 2.9%, up 0.2 from November. The core is up 0.2. That's a little bit less than last month, which is some good news for the Fed there. 3.2% on a year-over-year basis. That's down from 3.3% the month before. So overall, some reasonably decent news there. Let's take a look quickly here at some of the biggest numbers that we normally get in these things. We see gasoline prices down, up by 4.4%. We saw that impact in the PPI as well. New vehicles up 0.5%. Used cars up 1.2%. That's a little bit lower than the 2% last month, but still not great news. Apparel up only 0.1%. And the one number that everybody always wants to see, of course, is owner's equivalent rent. What are we doing in terms of the overall housing market? And owner's equivalent rent is up by 0.3. That's a tick higher than last month. So maybe some of the progress goes away. I'll let you see what's happening in the markets, and we can come back with more in terms of categories.
Look forward to it. Stay close, Mike. Thanks for that. This market's trading on core CPI, coming in just a bit softer than expected at 0.2% month over month, excluding food and energy. The estimate was 0.3. And the move looks like this. Check this out. Talked about this yesterday when we got PPI and the downside surprise there. This market is so jittery around inflation. You get any sign that things are a little bit better than expected, we're off to the races. Equities up by more than 1 full percentage point on the S&P, on the Nasdaq up by 1.3, on a Russell, the small caps up by 1.8. Check out the bond market. Yields dropping at the front end of the curve by 7 basis points, down 8 on 10s. That unlocks a bit more dollar weakness. Euro dollar back through 103, 103.45. And I'm thinking of you, the UK. I'm always thinking of you in the UK. Gilt yields a whole lot lower. Inflation surprised to the downside in the UK a little bit early this morning. And no doubt, Danny, this move stateside just takes a little bit of pressure off foreign authorities as well. In the gilt market, 10-year yields are now down by close to 14 basis points.
Well, to your point, they were already rallying because of that better CPI number, as in weaker CPI number coming from the UK. But the rally is taking on a new life of its own. These numbers are so important. It is not just the UK. It is a lot of the UK. It is also Japan. It is a BOJ that seems like it wants to hike. But in order to do that, it needs to have inflation, at least these kinds of figures coming in. It needs to have a Fed that isn't hiking rates. You can see that now, the yen up more than 1%. So many different markets internationally, be it EM, UK, and Japan, were waiting on these numbers, and they will have big consequences for their central banks.
David Kelly's with us around the table. David Kelly of JPMorgan Asset Management. David, good morning. Good to see you.
Good morning.
You expected to see more of this, softer inflation prints in the months ahead?
Yes, I do. I think it's important to recognize that the year over year, which is kind of high right now at 2.9, that's going to look a lot better by April, because the first 4 months of last year, we saw pretty strong inflation. So that makes it very easy to get down to a low twos by April. And overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now. It's got a lot coming up on the plate here, but overall, feel pretty good about inflation.
We'll talk about what's coming up on the plate, and I assume you're talking about incoming policy changes potentially. You've written about this. Sources of inflation, labour, energy, goods and services. Where do you have the most confidence now?
I think the most important is the labour market, and I think what we've seen is American workers just won't ask for a raise. It's remarkable. I mean, we saw production non-supervisory workers' wages up 3.8% year over year. We've got 8 million job openings. Everybody knows it's hard to find a good employee, but yet quits rates are below where they were before the pandemic. And either American business is great at saying why they're not going to give people a raise, or American workers are just wimpy about asking for one. But whatever way it works, we're just not getting inflation coming out of the labour market. And without that, you cannot get sustained inflation.
Just to that point on the labor market, as we're digesting CPI, you have had these individual announcements from companies, be it from Meta, Microsoft, Southwest, Citi when it comes to benefits, about reducing hiring, not hiring, or even letting people go. Does some of that softness, do you look at that and say these are idiosyncratic company events, or does it suggest that something has indeed shifted in the labor market in terms of who has the power and overall represents some form of softness?
I think it's good messaging from these companies. There's nothing like announcing prospective layoffs to quieten down the labor force. So I think it's a way of really suppressing wage gains. There's no evidence in GDP. I mean, if you want to figure out where employment going, look at where GDP has been, because the last 4 quarters, the current quarter and the previous 3 quarters, are a very good driver of payroll employment. So I know that the rate of growth of this economy is capable of generating 150 to 175,000 jobs per month as an average through this year. And that forecast is good for at least the next 3 to 6 months anyway. So there really isn't any softness in terms of the overall economy, but businesses, they focus on margins, they focus on efficiencies, how can we be more productive? And yes, if that means announcing, well, we're going to have to lay off a few people, then that actually works in terms of maintaining cost control.
David, John mentioned energy, and that was a big part of this inflation story for this print, 40%, I believe.
Yeah.
IEA overnight was saying actually they see a smaller glut next year. How concerned are you that fighting energy prices, higher oil prices, higher gasoline prices is going to be a concern for 2025?
Not too much. I mean, if you look at the global composite PMI index, you've got a global economy that is kind of muddling forward. The US is doing very well. Places like India and Italy are doing well, but a lot of Europe and particularly China are pretty soft here. That's not going to generate a lot of demand. Meanwhile, I think with the change in administration, you could get two things. One, you may get a peace settlement in the Middle East, which could dampen down tensions a little bit and concerns. And then secondly, you're going to have a very pro-drilling policy, which could increase US production, and some deregulation, which could help the energy sector. So overall, I don't think energy prices for fossil fuels are likely to go up significantly over the next few years.
If you are just joining us, welcome to the programme. 7 minutes ago, inflation data dropped and came in a little bit better than expected on core CPI, excluding food and energy, month over month coming in at 0.2%. The median estimate in our survey was 0.3%. On headline inline at 0.4%, the estimate was 0.4%. Of course, we're trading off the back of that downside surprise on core CPI, and it's unlocking much lower bond yields across the curve. The 10-year is now lower by 10 basis points, the 2-year down by 9. That unlocks some dollar weakness and euro strength, euro dollar at 103.40, and equities a really big lift to stocks. On the S&P up by 1.4%, likewise on the Nasdaq, and on the Russell the small caps are absolutely flying this morning. On the Russell we are rallying pretty hard going into the opening bell, up by 2.9%. David, you talked about the incoming administration. Danny talked about this earlier, the cost of not making your plans clear. You think it's high yields. Is that what's playing out in the bond market? Not this morning, but leading up to this move.
Oh, yeah. Yes, I absolutely. Because we don't know how far we can push the global bond market. And on Friday, we're going to get some new numbers from the Congressional Budget Office looking at, if we don't do any tax cuts from here, if we don't even extend the tax cuts we've got, I think they'll still show the debt to GDP ratio rising to about 120 to 125% of GDP by 2035. It looks like the budget deficit for this year could come in at over $2 trillion, and half of that is interest. And these higher interest costs that we're seeing, it's a negative feedback loop because it's actually pushing up the deficit. And the question is, well, how much can the government borrow from global capital markets at very cheap rates?
You said in your note, the most dangerous 3 words in economics are, quote, wait and see.
Yep.
What do you do then in this environment where Trump wants to be unpredictable? That's part of the policy.
Yeah, and it works, it works well in football, it works well in military maneuvers, it does not work well in macroeconomic management. You actually have to let people know. I mean, that's why the Fed spends so much time saying, we're looking for 2% inflation and just tries to, telegraph their punches all the time. And that's really what you should do in macroeconomic management. So, yes, I think there is an uncertainty tax. Absolutely, because the problem is that if you don't know what the administration is going to do in terms of taxation or deficits, you don't know where interest rates are going to be, what's the easiest thing for business to say? Well, let's wait and see. And when everybody decides to wait and see, what they eventually see is not good. So it actually drags on the economy. It slows down economic growth. So I am not concerned about the economy accelerating a lot this year at all. I'd be more worried about it decelerating if we have some shock or make some mistake.
To Anne-Marie's point, though, this president, the incoming president, values a lack of predictability.
Yeah.
Are you saying that's going to be a permanent feature of this bond market through this administration, a yield premium, because we just won't have a clear plan?
It could be, but also because we're going into uncharted territory in terms of how much we're trying to borrow from the biggest borrower in the world is going to be borrowing more than they've ever borrowed before. We're at a delicate point here because we really need to, not only do we have to have a sensible plan in terms of revenues and spending, but we need a certain amount of predictability. If we sort of push through a budget plan which suddenly pushes us to a $4 trillion deficit and everybody says, oh, well, it's okay, we're going to grow our way out of it. We're not going to grow our way out of it. I mean, we have to do some sensible budgeting here. And yes, I do think that could push up long-term interest rates. And as I say, it's a feedback loop because that pushes the deficit to GDP ratio up to 7%, 8%. Those numbers make it very hard to finance this debt.
It's pretty a negative cycle. David, it's good to see you. As always, appreciate your time. David Kelly there of JPMorgan Asset Management. Inflation data, a downside surprise, the right kind of downside surprise on CPI, unlocking a big rally in this equity market and driving yields a whole lot lower in fixed income. Mike McKee's back with us with the details. Hey, Mike.
John, I think a lot of people care about the supercore all of a sudden again, the ex-housing number. That's gone down, up 4% on a year-over-year basis, but that is the second consecutive decline, and it is significantly off its highs as that continues to move. We mentioned housing up 0.3 for owner's equivalent rent. That's something people will keep an eye on because they want to see it keep going down. Motor vehicle insurance was up 0.2 after a 0.1 decline last month, so not progress there, but not bad. Airline fares are what's really going to catch a lot of people's eyes, up 3.7%. Remember, they were up about 8% in the PPI. And then just because we have to throw politics in for Anne-Marie, egg prices were up, but not all that much, just 3.2%. That's down from an 8.2% increase in November.
Mike, thanks for the coverage. Mike McKee there, driving things on the economic side of things. Joining us now to continue the conversation, Aditya Bhave of Bank of America Global Research. Aditya, you made a call in the last week off the back of payrolls. No more rate cuts in 2025. Does this data point this morning change things on the margin at all for you and the team?
No, I don't think it changes our mind, really. It's a good number. 0.2% on the core PCE. We were below consensus at about 26 basis points. This was even softer than that. But what's different this month relative to previous months is that we already have the PPI data. So we can very quickly go from reacting to CPI to then doing the read-through to PCE, which is what really matters at the end of the day. And if you look over the last 3-4 months, we're basically running at around 2.5%. Which is where the Fed thinks we'll be at the end of this year for the core PCE. So by the Fed's own admission, inflation is stuck around 2.5%. And then also on top of that, the labor market seems to have stabilized. And that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
Aditya, in that same call you made, you also said that should core PCE come in somewhere above 3%, then we'd start talking about hikes. With this data in hand, even if it doesn't change your call when it comes to no cuts, does it at least move us further away for having to talk about hikes?
I think that's fair. We were pretty upfront about the fact that the bar for hikes is still quite high. So getting to 3% is not a trivial thing, right? Even setting aside this latest data print, as your previous guest mentioned, we are going to go down on the year-over-year rate over the next 3 months, most likely, because the base effects are very favorable. So I won't be surprised if we're around 2.5% once we have the data through March. So to go from there to 3% is going to be very challenging, and it'll probably take some sort of exogenous shock, which could get hikes really into the equation. But equally, our point for now is getting from there to 2% looks quite challenging, which is why we don't see a rationale for continued cuts.
Is there some degree which we should look at these data points as a jumping off point? That is to say that we are going to see inflation's true path coming forward once we pass the inauguration, once we hear different policy for Donald Trump. Is this only the beginning of something that, again, could be an inflationary path?
It's possible. We'll really have to see. I mean, you talked a lot about policy uncertainty as well in the previous segment, and I think there is a lot of uncertainty. So we'll see how things play out. We have made it clear that we think the risks are skewed towards more inflationary policies, but nobody really knows what's actually going to happen, right? So we'll have to see how things play out. I think it is worth noting that last time around, there were a lot of expectations that tariffs would be super inflationary, but the dollar ended up absorbing a lot of the shock. There were a lot of exclusions and so on. So the tariffs didn't actually end up being that inflationary.
Well, then going to David Kelly's point, talking about this policy uncertainty and this wait and see, does this basically mean paralysis as you wait for this unpredictability, because the incoming administration wants a lot of optionality when it comes to how are they going to enact some of these things like immigration policy and tariffs?
Right. Sorry, I lost you for a bit. I'm not sure what the question was.
Well, are we going to have basically just economic paralysis, this wait and see, and can that in itself hurt the economy?
Right. So we're pretty optimistic on the trajectory of the economy, to be honest. Economic paralysis isn't really our outlook. We think we're going in with significant momentum. We are above consensus on growth for this year, primarily because of structural growth, right? So we see productivity as a big driver of growth over the last couple of years. We think that can continue going forward. So we think we can grow at 2.3% this year, with tariffs maybe putting some downside on growth, but then equally, if we do get some fiscal stimulus, that could buoy the growth environment.
Aditya, appreciate your time, sir, as always. Aditya Bhave there of Bank of America Global Research off the back of this inflation print. Aditya and the team changed their call in the last week. They don't expect any interest rate cuts in 2025. This inflation print just bakes a little bit more chance that we do get an interest rate cut through 2025. We've said repeatedly through this year, though, so far, and we're only about 2 weeks into it. This was a three-part story in January. Payrolls, really, really good. Great news. OK. CPI, downside surprise. That's 2 out of the 3. The third drops on Monday, January 20th. The biggest data point of the month is inauguration. And what's going to be interesting to see over the next few days is whether this move in equities, higher, bond yields lower, dollar weaker, sticks into next week when we're all expecting a lot of executive orders.
So there's going to be a flurry of executive orders the first 48 hours. Has it been explained to me? One thing I think we still are waiting on, though, we're going to have executive orders on energy, on immigration. What does Donald Trump do when it comes to tariffs? There are 2 competing factions with his and incoming administration. Not even all of these plans have been put in front of him, so he has yet to make a decision. Is it going to be what he promised on the campaign trail? Blanket tariff, 60% on China, 10% tariff wall around the United States? Or is it going to be an incremental approach that Scott Bessent on this program has talked about, 5% every few months, and then your adversary lets you know when it's starting to bite and they're ready to make a deal?
And who's to say we're going to get that anytime soon? Any clarity? Again, I go back to this idea. I keep seeing commentary over and over that this bond market is waiting for clarity and that we will get it once we get all those executive orders coming through. Unpredictability is a feature, not a bug of Trump's policy outlook. If you are waiting for some kind of clarity, that might be a problem. And again, it's this idea that longer term yields are going to continue to be higher because we're not going to get that clarity at least anytime soon.
We're getting whipsawed, data point to data point, and we get another data point or 2 next week from the incoming president, Donald Trump. If you're just joining us, moments ago, a little bit early this morning, about 17, 18 minutes ago, inflation came in a little bit lower than expected at 0.2% on core inflation, month over month. Stripping out food and energy, it comes in at 0.2. The estimate was 0.3. Unlocks much lower bond yields across the curve. On a 2-year, we're down by 8 basis points. On a 10-year, we're down by close to 10. Off the back of that move, push it through foreign exchange. The dollar is weaker. Euro dollar back to about 103. And in equities, on the S&P 500 up by 1.6%. The Russell is flying. And as we say all the time, this is the first move. Doesn't mean it's the right move. It's the obvious move. Let's see if this move sticks into the closing bell later on this afternoon. Let's get you an update on stories elsewhere this morning. Some breaking news as well from Apollo moments ago with the latest in your Bloomberg Brief. Here's Yahara Hackett. Hey, Yahara.
Hi, John. Exactly. Apollo announcing management changes this morning. According to a company statement, CEO Mark Rowan agreed to a 5-year contract extension. Meanwhile, Jim Zelter, who was just on this program last week, was elevated to president, which is a newly created role. John Zito, who was head of credit, will take Zelter's place as co-president of the asset management business. Meanwhile, shares of the biggest U.S. banks are rising in the pre-market after reporting better than expected fourth quarter results. At JPMorgan, traders posting their biggest fourth quarter haul ever, while Wells Fargo boosted its 2025 net interest income forecast. At Goldman Sachs, earnings per share handily beating estimates, and Citi announcing a $20 billion buyback. And Bloomberg News has learned that U.S. health officials plan to ban the artificial food coloring red dye number 3. The announcement could come as early as today, according to people familiar. The dye has been linked to cancer and is in products from candy to cold medicine. That's your Bloomberg Brief. John?
Yahara, thank you. Check out Apollo. That stock up by 3%. One of the best management teams on the street in asset management. Rowan sticking around for 5 years, a new 5-year contract. Zelter, Danny, getting a promotion.
And this also comes after there was some speculation as to whether Rowan would be going into the Trump administration. This is the kind of succession planning that gets the market excited. Maybe not ones like BlackRock or JPMorgan with...
Yeah, I wasn't going to name names, but you went there.
Why not?
But at least this one's cleaner. I will say that. Up next on the programme, setting you up for the day ahead, looking ahead to an opening bell with equities up right now quite nicely from New York. This is Bloomberg. If you're an equity bull and you woke up this morning and you were asking for a couple of things, I don't know, good outlook from JPMorgan, record earnings from the traders over at Goldman Sachs in the fourth quarter on the equity side of the business, just solid numbers from Wall Street, you got that. And then you asked for a little bit more. You wanted a downside surprise on CPI, and 24 minutes ago you got that too. Equities up by 1.5% on the S&P, on the Russell up by 2.9 with some movers. It's Manus Cranny. Hey, Manus.
Jonathan, that's a fairly great backdrop for risk. Jane Fraser had the high bar to deliver over at Citi. The stock is up just under 6%. Yes, FICC did really well, up 37% for them at Citi, but it's the buyback which is there. And in terms of the fly in the ointment, return on equity capital, that's a waypoint, she says, not a destination. Wells Fargo are cutting costs. They took a $647 million severance charge. Charlie Scharf is saying the cost cuts are in the early stage. They've gone from 272,000 down to 217,000. I'll leave you with a look at BlackRock. They have sucked in, the vacuum cleaner is on, they've sucked in assets under management, 11.55 trillion, up 15% on the year. And that was lighter than the estimates. Jonathan.
Stock is up by 5% on BlackRock. Manus Cranny, appreciate it. Thank you, sir. What a morning. More still to come. As we work through the trading week, the calendar looks a little bit like this. You'll get some Fed speak going into the quiet period at the weekend. Fed speak from Barkin, Kashkari, Williams and Goolsbee tomorrow. More earnings from Bank of America and Morgan Stanley, plus retail sales and another round of jobless claims, plus President-elect Donald Trump's Treasury Secretary nominee Scott Bessent on Capitol Hill for his hearing. Look out for that. On Friday, some more data, housing starts and building permits. Looking ahead to next week, inauguration on Monday and a World Economic Forum kicking off as well. And Anne-Marie, understand that the incoming President-elect Donald Trump is going to be calling in to the World Economic Forum from Washington, D.C.
Well, it'll be very challenging for him to get there, given the fact that he does have this America First agenda, and he's just being sworn in. So he's going to do all these executive orders and then probably lecture the global elite you'll be hanging out with.
And then I'll be asking him questions. What are you going to do? How are you going to respond? How do you feel about this? How confident are you about the year ahead? And the answer to that question will depend on whether you're based in America or elsewhere.
And you might just say, actually, we don't have enough information yet. It's still a lot of very unpredictable, and there's a lot of optionality.
Probably punting it is a good idea. Up next, tomorrow morning, we'll catch up with Cameron Dawson of New Edge Wealth, David Leibovitz of JPMorgan, Francis Donald of RBC, and the former Fed Vice Chair Richard Clarida. From New York, thank you for choosing Bloomberg TV.